Welcome to the ACCA Strategic Business Reporting, or the SBR Speedy course. I created the Speedy course for you to make sure that you spend minimum time to pass this paper. So, I've got experience acting as a marker, examiner, and also I'm the author for my 4 accounting books, all related to IFRS. And in my course, and with my years of experience, that I can help you pass this paper easily. Now, so you can see, firstly, you've got a copy of my own Speedy notes, fully complying with the study tests from the ACCA Study Hub. And the course has been divided into several sections, ranging from the introduction to the standard related to asset, income, expense disclosure, and even some of the I will say that the reporting issues in your syllabus, the ethics in the question 2, the consolidation in the question 1, and also from the investor's perspective, that why do we find it very useful. So 9 blocks covering the whole syllabus in a very quick manner. Apart from this, you also have a copy of a Speedy note answer. It's just to be the full answer here, for example. But what I'm going to be doing is that, firstly, I would like to integrate huge amount of past exam questions in the Speedy course before you go through the revision parts later on, for more complicated questions. Now, firstly, introduction to the Strategic Business Reporting exam. I will say that this exam is 195 minutes, but I will highly recommend my student to spend the first 15 minutes in planning and reading the question 1. So that's why, if I were to take the remaining of 180 minutes over the 100 marks, I would like to allocate 1.8 minutes per mark to do each of the questions in turn. And of course, in this paper, there are 4 professional marks, 2 in the question 2, all about ethics. Another 2 may be appearing in question 3 or 4. This means that you will need to attempt all the 4 questions, total 100 marks, 96 will be the technical marks, and 4 will be the subjective or the professional marks. Achieving 50 or more, you can pass this paper. Question 1 will always be, firstly, you will be given the pre-populated spreadsheet about the consolidation, which means that the examining team has done the line-by-line adding work for you. And what you need to do is to adjust each line of figure using workings. Now, the pre-populated spreadsheet consolidation adjustment will be worth at 12 to 14 marks each and every time, plus various accounting treatment. Total 30 marks for question 1, and for the question 2 will be 20 marks about ethics and some of the accounting standard applications. Question 3 and question 4, some of the requirements will be linked from the investor's point of view rather than simply the accountant's point of view, and 25 markers each, of course. So, which means that the question 1, 30 marks, question 2, 20 marks, question 3 and 4, 25 each, and that comes to 100 marks in total. My technique is to always use the simple sentence, because this paper is not about calculations at all, it's all about the application, and to see whether or not you've got the holistic view, which means the strategic view, which means that you will not be tested a single standard alone in most circumstances. The standards will be linking with other standards altogether, and I will show you how in a second. And I will always tell my students that if any requirements are more than 5 marks, make sure that you will use these 3 main headings in your answer about the quote from the IFRS. I will show you how in a second, and to apply your answer to the case and to give you a conclusion. By mapping with the conceptual framework requirements, I've got the speedy way to help you memorize these and directly paste them in to your answer. Mentioning about the ratio's impact on the financial statement may help. Now, what I would do is to directly take you through to the block 2 of our study in this section. Firstly, related to the asset. As you can see in the chapter content, we've got something that we'd like to sell, which means inventories, and agricultural accounting related to, for example, pig, and according to IS number 41. The property, plant, equipment, which means the land and buildings, factory and computer, and the interest expense that we need to capitalize that to the non-current asset. Sometimes the non-current asset may be impaired, and sometimes the non-current asset may lack physical substance, which means your patent, the franchise right. So these are the intangible asset. If you've got the non-current asset, you hold it, not using it on your own, but you hold it and to rent it to somebody to get the rental income, or hold it for long-term capital appreciation, and this is what I mean by investment property. If you decide to sell your non-current asset, you will need to reclassify that into the non-current asset held for sale per the IFRS 5. If you've got the contract that can be converted into cash directly, and this is what I mean by financial instrument. And of course, the financial instrument, as you can see, it's a huge standard, but I simply use several pages to summarize all the bits and pieces they need to know. Finally, we also have the IFRS 16 leases. Yes, I've got one of my published books about the leases, but in this exam, it will be much simpler, okay, than what we can see in practice. And we will be practicing quite a few areas in these standards to make sure that you're happy. Now, let's move on. Welcome to Chapter 1, Inventories. Now, what do you need to know? Firstly, this is holding the inventory, but the purpose is for sale in the ordinary course of your business, which means that this is not one-off. At the same time, this is not being used by the business on its own. Now, when we have the inventory, so for example, you can think about the pen, you would like to sell it, and of course, it's your main business, and this pen to you is the inventory. Now, what would be its value? I would say that how much that you spend to buy the pen, which means the historical costs, let's say $10. At the same time, you've got the delivery costs into getting this pen. You will need to pay for the transportation cost of $2. Perhaps you will need to install that in some way. If you've got other machines that is your inventory, let's say $3. There might be some of the specific storage related to this pen. For example, we need to put that into the fridge. Right, so $1. Plussing all of these, that becomes the value of inventory. And of course, for general storage costs, for example, the distribution overhead, we usually expense that. And of course, at the end of each and every year, we'll need to carry out the subsequent measurement. Of course, it will be following the rule of the lower of costs and net realizable value. The costs was simply that we can see before. When we are measuring the inventory using costs, for example, we've got different accounting policies. For example, using the FIFO or the weighted average method or cost method, which means that first coming in, first issuing out, and the weighted average cost, for example, that we simply mix all the inventories all together and to calculate the inventory cost value each time when we buy the new one. But in this paper, no worries for these terminologies. NRV, on the other hand, would just be the management estimate, or you can say that it's the accounting estimate, because all we can say is that if the cost of inventory was 15, for example, but if we decide to sell the inventory on our own, we estimate to get 10, which means the NRV, the inventory needs to be measured at NRV for the prudence reason, okay, according to the conceptual framework requirement. So that's why that when we look at the conceptual framework requirement, that if you've got the asset impairment related to the inventory, which means the inventory is valued at NRV because we can't recover all of our costs, that's according to the prudence reason, which means that we can't overstate the asset as well as the income value. Of course, changing the accounting policy, which means from FIFO to weighted average costs, and that would be a change in accounting policy. You will need to apply the retrospective adjustment, and I will tell you how in a second. And of course, if any sort of impairment, but subsequently we estimate that the market is becoming much better, then the cost is now more than NRV, so the previous impairment of inventories, for example, from 15 down to 10, that $5 of impairment, we can reverse it back. We can reverse the impairment. So make sure that you understand that we can always reverse the impairment if conditions saying that the inventory condition is quite good right now. How can we calculate the NRV? This is what the examining team in this paper is very interested in. I will say that firstly, you will need to estimate what will be the selling price of your inventory. Usually that we obtain the price lists of the inventory, even from some of the contracts that you signed with another party, but not yet being executed, which means not yet implemented. So you take the price from there. You need to minus any sort of related costs to sell the inventory and even to complete the inventory in order to complete the sale. So for example, in order to sell this pen, you will need to incur the commission costs, paying to your sales staff. And this is what I mean by the cost to sell. And even that you need to spend money out in fixing the errors in the pen, which means the cost to complete the sale. And you will need to minus all of these, but not the original of $15, because the original of the historical costs would just be the costs happened in the past. There's nothing to do when you sell the pen. And of course, finally, according to the conceptual framework requirements related to inventory, who actually controls the inventory, and we will need to put the inventory in that party's financial statement. Okay, and that's it. And of course, we'll see detailed examples later on, okay, that following the substance over form concept, the form, which means according to the contract, that doesn't really matter from the accounting's point of view. We need to account for the transaction according to the economic substance of that. And of course, we'll see a particular application related to who controls the inventory, or I can call it as the consignment, in a second. But it's more important that after we've gone through the ICE number 2, I will say this, the general theories, but now let's see how the SBR exam will be testing this topic. I've said that this paper would test each of the accounting standards in combination with other accounting standards altogether. And let's see how this is tested. Now, 1.1, housing. Firstly, 2 marks, okay? Now, with your permission, could you please take out a pen and a paper, or you can copy my answer if you're using computer, for example, and we will be solving each of the question line by line. Now, firstly, this question is called housing as a starting point. 2 marks, 2 points. We're told that the local government supplements the income by buying and selling property, and the housing department sells its housing inventory in the ordinary course of its operations. So as you can say, it's regularly, and this housing is in the ordinary course. I will say that firstly, it should be recognized as inventory because we've got the keywords regular and the ordinary course of its operation. Part of the inventory is to provide housing to low-income employees at below the market rent. The rent paid covers the maintenance. All right. So it seems that in substance that the house that we provide to our employees, that we are also incurring the maintenance costs, but it's the employee paying for that. But that does not really matter because per the ICE number 2 says that for the housing that we provide to those employees, that the internal use of these houses will certainly be recognized as property, plant, equipment, not inventory. Okay, that's how you gain the 2 marks. You don't really have to comment on the final sentence, for example. Next one. I mean, these questions are coming from a past exam, so make sure that you're ready. How to account for them? Now, we're given 4 marks here. Internal POC. Okay, let me just write them down. It's the internal POC. Receives lots of certificates from government for free, which can be sold to other companies. Now, firstly, this is recognized as inventory because the purpose is to sell to other companies. Okay, so bringing exhibit clues into your answer, that really helps. However, that receive certificate from the government, so it seems to me that it's a government grant because the company received from the government. Because as I said, when we are accounting for inventory, this should be accounted for as the initial measurements at historical costs, which means the price they pay for it. We haven't paid for anything because we got the certificate from the government. So therefore, the final 2 points, I would like to remind the examining team of how we should account for each of those in turn. We receive the certificate from government, we debit inventory, and credit, I would say that is the deferred income liability. Now, of course, that should be accounted for under the ICE number 20, government grant. But let me explain. We've got the inventory, we'd like to sell it and to convert that into profit. So somehow in the future, we will get the income. But when we receive it, we'll put that in the deferred income liability. Now, according to ICE number 20, that's the bonus point, that you can say that, well, what would be the value of that? I mean, we acquire it for free. But according to ICE number 20, that we can say that we can either put the fair value to the inventory answer deferred income liability, or the notional amount. The notional amount usually will be $1. Okay, putting them into the account. Okay, right. We're also told that both these certificates are not sold at the year end, but I can say it's my final point. If you are given 5 marks, for example, we sold it, that becomes our revenue. Of course, per the IFRS number 18, that should be staying in the operating category and the associated cost of sales. So you can recognize the gross profit from it. Of course, gross profit subtotal is now not required by the IFRS number 18. Moving on. Next one. I would say that a bit tricky. Now, the application 3 here, 1.3, field. Okay, now, let me deal with our question with you, step by step. Here, that is all about the executory contract, which means that we've signed the contract already, but not yet implemented by both parties. Now, accounting treatment, 4 marks here. Now, we're told that it extracts coal besides day-to-day spot sales, which means selling to the public. It sometimes signs forward contracts with key customers to lock in future deliveries, which means that I'm going to be saying to you, okay, right, please, let's sign the contract. I would like to sell this pen to you in 10 months at $10. So lock the price today. We've got 10,000 tons of coals. We've got 6,000 covered by the forward contract. Now, as a starting point, I will tell the examining team that I've got 10,000 tons and 6,000 tons will be covered by the forward contract, which means that the remaining 4,000 tons not covered by the forward contract. Now, the forward contract says that the fixed price will be $34 in 3 years' time, which means that when we are measuring the value of the inventory, what we can do is that we can take the estimated selling price worth of 34 as a starting point to determine that NRV. Is the executory. All right. The contract term says that coals are for physical delivery only, which means that we will need to execute the contract in a cash market. Now, why am I saying this? Because later on we'll see another example that relates to the financial instrument. Because if we can do the opposite, which means we open the deal and we close the deal. When we close the deal, if it does not involve physical delivery at all, so if that's the case, that is not related to the financial instrument. Now, the cost to complete and sale will be $7. This means that in the forward contract, for those 6,000 tons, that would be the NRV of $27 per ton. Now, that's related to the NRV. How about the original costs? Well, the original costs, we're told, in the final point, was $28 per ton. Think about it. According to item number 2, the lower of costs and net realizable value will need to choose that NRV as a starting point. So 6,000 tons, of the inventory will be measured at $27 each, times by 6,000, becoming $162,000. How about not covered? Well, the cost will still be $28 per tonne, but not covered, we'll need to use the best estimate of the estimated selling price. Now, of course, we signed the contract on 30th November at 6. However, we expect to sell it in 3 years' time. So that's why from today we estimate the estimated selling price in 3 years will be 32. And that's why, not covered, the NRV will be 32 minus 7. That becomes 25. 25, again, is lower than the cost of 28. We take that 25 times by the 4,000 tonnes, becoming $100,000. So the total inventory value becoming $262,000 there. How about the inventory impairment? Well, I can say that the original of 10,000 tonnes, each tonne worth at $28 of cost. The total cost, that becomes $280,000. This means that as the next point, I would say that the inventory has been impaired by 280,000 minusing 262,000, becoming 18,000 there. Okay, so that's what we need to do. Now, this example, 4 marks here. How can we award you marks in this paper? Firstly, you've calculated this correctly. You've calculated this correctly. You've done the costs and total value of the inventory as a subsequent measurement. And also you've spotted the impairment of inventory. You've got these 4 marks very easily. Now, let's see the application 4, which means the 1.4 here. Everything stays the same except that we are changing this term. We are saying that the seller, before the delivery period, we can offset the contract by entering into the opposite contract. Now, if you have traded, for example, the futures contract in real life, such as what I did, is that we can open the deal and we need to close out the deal. And of course, when we are talking about the financial instrument, I mean, that would be coming from another accounting standard, just to give you a feel that how the standards will be interlinked with each other. I would say that if you're a seller, if you sell something in the cash market, you can also open the deal by selling the futures contract, and we close the deal later on and you will need to buy it back. Because we profit from the financial market always by buying low, selling high, which means that initially we sell at high price and we close the deal by buying at a lower price. Later on we can enjoy the gain. From a buyer's point of view, if you buy something in the open market, in the cash market, buying an apple, for example, spend the money out. At the same time, you can open the deal, for example, the forward contract or the futures contract, by buying something always been the same direction in the cash market. You can close the deal by selling it at the higher price, and you can profit from it. All right, now, this example, fuel company extracts coal and sell it, which means I'm the seller. Instead of waiting for the end of the third year to carry out the physical delivery, but now we can enter into the equal and opposite contract to close the deal, which means we can buy it from the financial market. So if that's the case, then I will say that, let me point this out, the next question. I will be solving lots and lots of past exam questions with you. Firstly, I would like to say that this is a financial instrument. Do you need to quote the specific number from the IFRS 9, for example? But the answer is no, you don't really have to. Now, of course, I would like to point this out that this is what I mean by the fair value hedge. Okay, it's just to be an example of the fair value hedge. The reason why this is the case is because you can say that, well, we've got the inventory, which means the coals, in our statement of financial position already. And we would like to enter into the forwards contract. And the forwards contract, we also have got the gains and losses to offset against the value existed in the statement of financial position. So this is what I mean by the fair value hedge. We're hedging, we are protecting the value or the fair value changes. Okay, now of course there will be other ways of a hedge accounting. So for example, it's the cash flow hedge. I'm not going to be detailing that at the moment because I will show you when we come to the IFRS 9 in a second. Now, what we can say is this. Firstly, from the previous example, the impairment of inventory was 18,000. You can perform the same stuff in this question. Now, the impairment would just to be the same, about 18,000 from the previous question. All you need to do, yes, debit cost of sales and credit inventories, but I don't think that really matters. But what really matters will be related to the forwards contract itself. Firstly, according to the previous question, that 6,000 tonnes will be covered by the forwards contract. So that would be as a starting point. At the same time, we're also told that in the price that we signed with the customer worth of 34, but the estimate will be 32. Let me remove all these bits and pieces of nonsense just to compare these two figures. So this seems to me that we aim to sell at 34, but actually now we estimate it only to sell at 32. Now, from 34 to 32. Now, the question is, do we profit or loss from it? Because we are the seller. So next point, obviously. We always sell first. We sign the contract at 34. But eventually, for example, if at the end of the third year, we entered the opposite amount, or the opposite contract, with the equal amount to close the deal at 32, well, we can profit from it. So that $2 will be the profit. And that's why times by 6,000 times there, we can profit 12,000 there. According to the fair value hedge accounting, all we can do is to recognize it as a gain. we put it in the P&L worth of $12,000, and we increase the inventory value up by $12,000 there. Yes, as you can see there, we improve or to increase the inventory value. Usually this is not allowed by the accounting standard, except that we've got the fair value hedge. We are allowed to improve or to increase the inventory value, because inventory value, according to IAS number 2, inventories will always be impaired. We can only write down inventories, not upward, but this is the exception there. Now, per the IFRS number 18, that the P&L of 12,000 go into which category? I would say that it really depending on the underlying item that you're hedging against with. Because you're hedging against your inventory, that's something to do with your operation. So the gains and losses from a fair value hedge of 12,000 but also go into the operating category. Make sure they're ready. Moving on. Number 5. Oh, again, it's the feel again, but this time it's all about the onerous contract according to IAS number 37, provision accounting. Which means that if we were to exercise the contract, we'll suffer a loss. Now, I told about 4 marks there, so let me write it down as a starting point. Feel again. So 4 marks, okay, 1, 2, 3, 4. But in the exam, you will need to write it in full sentences. You can always check the full answer, okay, for my questions, okay, in the back. Now we're told that Phil badly needed cash to pay a big mining bill. All right. A nearby cement factory said that you want cash. Okay, we'll give you cash now, but you must sell us 6,000 tons of your coal in 3 years for just $24 each. However, the historical cost will be $28, which means that we can sell at a loss. The best estimate price by management in 3 years' time, again, 32, and the cost to complete and sell was 7. Now, if we were to enter into this contract, I would say that firstly, the NRV, we can compute up to be 25 because we take 32 minus 7 as a starting point. And the historical cost was 28, so therefore for the 10,000 homes, they're subject to impairment. Now I would say that as a starting point, it should be the lower of cost of 28 and the NRV or net realizable value. Here, 32 minus 7, you know how to calculate that right now, worth of 25. On the 10,000 homes, that becomes a write-down of 30,000 of impairment. 1 mark is there. How about second mark? Because the inventory is now carried at the NRV worth of 25. This means that the inventory was now $25 on that 10,000 tons. That becomes $25,000 there. Okay. Now, here's the thing. Because if I were to sell that 6,000 tons just for $24 each, so if that's the case then, that would be the loss-making contract. Why? Because each ton, for example, now worth 25. But if we were to sell at how much? 24. We will lose $1 from it. So which means that we will lose $1 per ton. Apart from this, we'll also incur the cost of completing and selling the cars of 7. So for each time, we will lose $8 there. And that's why, per the ICE number 37 about the provision accounting, for the onerous contract, which means the loss-making contract, we always need to debit the P&L, which means related to the expense, and to credit to increase up the provision liability. $8 per tonne for that 6,000 tonnes, that becomes $48,000 there. All right. So make sure that we are ready. Now, finally, for the P&L, according to IFRS number 18, that goes into the operating category related to that inventory. At the same time, in this question, it doesn't tell us about any exit costs related to the penalty. Because in this particular question, the penalty equals to 0, and that's why we'll need to consider the loss of implementing the contract worth of $48,000 there as the provision liability. Make sure that we are ready. Moving on. Yeah, not far away that we can finish the ICE number 2. Number 6 for the PP&E. PP&E, 2 marks. We've got the self-constructed PP&E, which means we build a building on our own, incurring raw materials, direct labour and production overhead costs. Right, I love that. Now, related to this question, as a starting point, I will always say that the materials, labour and overhead, when we are still in the process of constructing a building, will be in a work in progress, or WIP, if you like. Because firstly, that we've got the raw materials, and then turning that to the WIP, and finally to the finished goods, and that's all we need to know. Before we finish all the PP&E, yes, we have the raw material costs, labour costs, we put them into the work in progress as a starting point. And after that's finished, all we will do is to transfer the WIP into the property plant equipment. That should be accounted for under the next accounting standards, IAS number 16. That's it. Finally, right, we've got the application 7. It's all about the control stuff. We've got the consignment sale of cars to the dealer. Now, what that means is we've got the control company being the producer or the manufacturer of cars. It will sell it to the dealer, and it's up to the dealer to sell it to the final customer. Now, here's the key. The dealer needs to bear all the insurance and non-sale risk, which means that when control company transfers the car to the dealer company will bear all the risks and rewards of the cars. This means that, as I said before, who bears the risk and rewards, who would recognize the inventory. This means that, okay, so this question is called control company. That who bears risks and rewards, who should recognize inventory. In this case, when the sale takes place, that the dealer would recognize the inventory in the account. That's all you need to know. Although the item number 2 inventories would just be the assumed knowledge from your previous study. In this paper, as you can see, that we've got at least 7 applications. I would say they're a bit complicated, but it's fine. When we come to our revision later on, we'll also see other applications that in more complicated exam questions. But so far, hopefully that you're happy. Don't stop, just move on to chapter 2, item number 41, agriculture. Think about it in this way. You've got a pet. Can we account for it under the item number 41, agriculture? Well, the answer is probably not. The reason is you're not consuming it. Okay? Which means that although it is the living animal or plant, you're not aiming to eat it. You aim to treat it like your baby, for example. So if this is the case, then this is not the consumable biological asset. Your pet should not be accounted for under IAS number 41 there. Now, according to IAS number 41, agriculture, as a starting point, we've got the biological asset. We can either have the bearer biological asset, we treat that as the property, plant, equipment, PP&E. Now, the bearer biological asset will simply be the trees, the apple trees. We aim to grow apples. It can also be the consumable one, which means the consumable biological asset. It's the living animal. So, for example, we've got sheep, we've got pig, it's fine. All we need to bear in mind is that we always value it using fair value minusing any cost to sale, for example, the commission costs. When we account for the fair value, we always minus the transportation costs from it. Which means the net price that we can get. And at the end of each year, we'll need to remeasure it using the same principle. Any gains or losses, we put that directly into the P&L. Of course, that gains or losses, we can also, from the voluntary disclosure's point of view, to disclose part of which will be related to the physical change, because, for example, for a big growing larger, and part of it would be related to a price change, okay, because of the inflation effect. Now, once you've got that biological asset, make sure that you're ready. That when we kill it, at the point that we kill it, or we shake off the tree and we get the apple, at that time, that becomes the agricultural produce. And that's part of the inventory, but the agricultural produce needs to be accounted for under IAS number 41, which means that, again, fair value minus cost to sale again. We debit inventory for the agricultural produce, and we remove all the biological asset carrying value, gains and losses, we put that into the P&L at the point of detachment, for example. But after that, that should be accounted for under IAS number 2, inventories, as we've seen before, which means that the lower of cost NRV. When you have the government grants giving you the living animal for free, for example, by government, you simply debit biological asset and to credit deferred income liability, and you release that deferred income liability into the P&L each and every year. If there are conditions attaching to this help, if not, you directly put that into the P&L. Okay, that's all you can do into operating section according to IFRS number 18. I must say that I've talked too much, but it's time to practice. Let's bring all the bits and pieces into this example. Yes, 5 marks that we will need to know is the accounting treatment at each stage. Now we're told that we've got the biological asset at the start, which means the piglet, they place in the pen. Okay, it's a small pigs if you like. And at the year end, pigs are still alive because they are on the hoof. However, next year, we harvest these pigs, which means they became carcasses, dead bodies. They became pork. This means that at the time that they become pork, that's an example of the agricultural produce. We should be accounting for that. And after that, that should be accounted for under ICE number 2 inventories. Now, let's move on. Firstly, the initial recognition, we've got the biological asset worth of 1,000 kilograms. The market price, after considering the transportation costs, worth of 2, and to minus any estimated selling cost of 0.2, that becomes 1.8. Which means the fair value minus cost to sale, worth of 1.8 there. For the 1,000 kilograms, we times by 1,000, that becomes 1,800 as a starting point. Now we'll say that, well, this question is called pigs. All right, do you like pigs? Thirdly, for the initial recognition, we'll need to increase the biological asset. This is not a bearer plant, it's not an apple tree, these are the living animals. I will say that they are consumable biological asset. At what value? That we will need to account for using fair value minus cost to sale, worth of 1,800 as a starting point, and we directly put that into the P&L. Now, at the year end, as you can see, the quantity now improves to 1,500 kilograms. And of course, the fair value minus cost to sale now becomes 1.9 times by 1,500, that becomes 28.50. So the fair value changes there. I would like to take the total value of 28.50 minus the original 1,800. That's an improvement of a gain of 1,050. How can we do it? Well, all we can say, again, with debits to improve the biological asset, usually we put that in the non-current asset by 1,050, and we credit P&L in the operating section, the P&L 1,050. That's all we need to do. Now, so you can see the fair value changes there. Part of it will be related to the physical change, because from 1,000 kilograms to 1,500 kilograms, part of that will be related to the price change. Because as you can see, from $2 to 2.1. So we can disclose these sort of information on a voluntary basis. Which means that you can choose to disclose it, but it's entirely up to you. Now, at the point of harvest, that becomes 37.80. I've just done the number crunching exercises for you because I've took the fair value minus cost to sale and times by 1,800 kilograms there. So at the point of harvest, we'll need to recognise the inventory worth of 3780 and to remove all the biological asset. Now the biological asset value that we recognised before has been updated to 2850 in the second stage. So we put the balancing figure into the P&L as the gain of harvests worth of 930. So after that, just put a note on that. The 3780 inventory should be valued at the lower of costs, which means that 3780 a net realisable value, okay, per the item number 2, inventories. That's all we can do. Hopefully so far, you're happy. If you're happy, let's move on to another accounting standard in the chapter 3. Okay, so we are at chapter 3 now. Congratulations. PP&E, property, plant, equipment. Property is the land and buildings. Remember, land never depreciated. In the item number 16, plant is related to your factory and equipment related to your computer and other equipment, which means that usually in a business that we've got the class 1 PP&E, which means related to property, the class 2 PP&E, which means related to plant, and the class 3 PP&E, which means related to equipment. So when we set accounting policies, so for example using cost model or evaluation models, we should be applying the same accounting policy to each class of PP&E. Now, for the PP&E, we always recognise it as a non-current asset in the SFP. So remember that held for use, not held for sale anymore. From our previous example, so even though that we've got the apartment, we allow our employees to use it, which means allowing the business staff to use it, it is held for use. Now, for the initial measurements, just to be similar to what we've seen in the inventory measurement, we include the purchase price, the installation costs, the delivery costs that we pay, and even the lawyer fee that we draw up the contract. So we'll need to plot all these figures, let's say $100, and we put that as the PP&E value. However, in this exam, there might be other capital expenditure. Apart from $100 of the capital expenditure, there might be part replacement. For example, we've got certain parts, for example, engine, that we may be replacing the old engine with the new one, for example, for every 5 years. And that being the case, that the old engine needs to depreciate it over 5 years until the new one comes into being, and the new one, the new costs, will need to put that as the PP&E value. Some of the major overhaul costs that needs to be there, for example, for aircraft, that, for example, every 3 years, we will need to spend, let's say, the 50% on costs as the major overhaul costs. Now, if you can say that these sort of major overhaul or the inspection costs that need to be capitalized, which means put that as the PP&E value at costs. any sort of dismantling costs. So remember, dismantling costs, yes, we can see that quite frequently in the exam, that if you've got, for example, the oil rig, you may need to decommission it at the end of the 30 years. So if that's the case, then you will need to estimate how much money that you need to spend in 30 years' time. And we need to discount these costs into today and to debit PP&E and to credit to increase the provision liability. Make sure that you're ready. So, next time that you can see, well, we may be estimating that we will need to spend 1 million to decommission the asset at the end of the 30 year. Okay, that 1 million needs to be discounted today as the provision liability. Make sure they're ready. Borrowing costs, we'll touch that later on. We'll always need to capitalize it. Right, when we sell off that PP&E, the gains and losses would go into the P&L. Of course, according to IFRS number 18, that P&L category, we put that in the operating section. Now, I keep saying to you that the P&L places, because according to the latest accounting standard, which is the IFRS number 18, it needs to be in line with the statement of cash flow. And that's why in the P&L nowadays, that it has operating category, investing and financing category. Now, I don't want to complicate this area here, but just to give you a simple rule, but we will detail that later on when we see it, is that 9 out of 10 put them into the operating category, and that's it. But if that relates to the finance cost, which means the interest expense, we put that into the financing category. How about for the investing one? Well, if you've got something that you hold it, but you're not operating it, but that something can generate return without your intervention. For example, you put your money in the bank and earning interests. So, into the investing category. But I don't want to complicate this area here, and we'll see that later on. I mean, in the course, just as you can see, that I'm trying to combine all the bits and pieces all together, because this paper requires a strategic mindset. Now, the monies that we spend as the revenue expenditure, we put that into the P&L. For example, training our staff, marketing, maintenance of our equipment, repairing our equipment, and even other running costs that we spend the money out in paying our staff, and even depreciation expense, we can say that it did not improve the capacity of our current equipment by spending these monies out. And that's why when we spend the money out, and when we are about to spend it, we put that into the P&L as the expense. That's all we can say. From the accounting policies point of view, as I said before, we can use the cost model using the initial costs, for example, the purchase price and delivery, and to minus the accumulated depreciation. So each and every year, we can have the carrying value. But if we decide to revalue, that's a change of accounting policy. But according to the latest IAS number 8, although changes in accounting policy requires all the retrospective adjustment, which means adjusting all of your previous financial statements, but here is the exception that we don't really have to do it. We simply, if we were to change from cost to revaluation model, we don't really need to revalue the previous properties because that's not practicable. And that's why all we can say is that we will look ahead for all of our properties using a revaluation model. We will be applying that model for these properties from a current and for the future period. So we will need to follow a few rules. We will need to conduct frequent revaluation, but the IAS number 16 did not say how often. The new depreciation, we need to base on the new revalued amount, because the new revalued amount will automatically becomes the new cost of a PP&E. Any revaluation, putting that into the OCI, which means the other comprehensive income, in a statement of profit or loss in OCI. And then, at the same time, I will say that at the same time, into the revaluation reserve, into the SFP, which means the statement of financial position. When we sell off that property, any sort of revaluation reserve will need to be classified into the retained earnings. And that's all we need to understand. But let's apply all of these bits and pieces or nonsense into a few questions. Now, firstly, 3.1, traveller. Okay. Do you write this question down? Traveller. We'll need to see the depreciation accounting treatment. Now, it acquired a new factory on 1st December. The costs 50, residual value of 2, has a flat roof, replacing every 5 years, and the costs was 5. Okay, so this means that within that factory, you've got the roof as a starting point, and then the rest of the factory. You always need to depreciate your separate asset. That's very important. Now for the roof, we're told the cost of 5. We'll need to see the accounting estimate, because anything related to depreciation, that will be accounting estimate. The useful life of a factory is 25 years. However, every 5 years, we need to replace that roof. And that being the case, the roof needs to be depreciated over 5 years. For the rest of the factory, that would be 25 years. Okay? So, we're told that the residual value of the factory was 2. How about the cost of factory? We're told that 50. So 50 million, not including the roof of 5, minusing the residual value of 2, that becomes the depreciable amount. That becomes the depreciation for roof of 1 million and 1.72. So total will be 2.72 there. That's it. Of course, if you want to know more about the accounting entries, in this paper, we simply debit P&L, 2.72 in the operating category, and credit PP&E of 2.72 as a starting point. Of course, in real life, we credit accumulated depreciation. Moving on to rows 3.2 now. All right. We covered lots and lots of things so far. So excited about it. It's talking about the excessive depreciation, or the excess depreciation here. Now, we're told that we purchased a plant for 20 million on 1st May. 6-year life, residual value of 1.4. However, that 3 years later, the residual value changing that to be 2.6, which means an increase of residual value. Now, the best way to show this, from my perspective, is that in the actual exam, you will be given the spreadsheet, and therefore do the number crunching on the spreadsheet directly. Here, my approach will be to list down the timing and the amount. On 1st May, X7, they purchased a plant worth of 20 million. And for the 3 years, depreciation, or depre, if you like, I always like these words, depreciation. We take the cost of 20 million, minusing the residual value, the original residual value of 1.4 there, over 6 years. And 3 years have passed by. And that being the case, 9.3 there. So the carrying value after the 3rd year that we change the residual value being 10.7. That becomes the new cost, because at this date that we change the residual value to be 2.6. There'll be no change in the useful life. It's a change, something to do with the depreciation, and that's why it's a change to the accounting estimate. So taking a new cost of 10.7 minus the new 2.6 residual value over the remaining of 3 years, the new depreciation each year now becomes, I will say that it's a 2.7. Okay. Now, what the question is all about is that originally, if we took 20 minus 1.4 over 6, the old depreciation was 3.1. The new depreciation here is 2.7. Can you see that? So what's your thought? Well, I would say that the expense seems to be quite less than before. So this means that we can save 0.4 million if I were to take 2.7 minus 3.1. So saving that 0.4, all we can do, we can perform the entry. We can put that in the retained earnings. Of 0.4. And we can improve that PP&E of 0.4 there for the saved depreciation. So make sure that we are ready for this particular circumstance. Moving on. A bit complicated, this one. Is the revaluation reversal, which means that we revalue the property upwards and then downwards. Now, again, as I said, starting point, you know that. A shanty. As we read through the question, just to copy the information in. We cost 12 million purchased on 1st May X2 of a PP&E value. Over 10 years depreciation with no residual value on 30th April 20X3. Alright, which means 1 year later, revalue to 13, so which means that we'll need to depreciate 1 year, which means that we take 12 million over how many years? 10 years depreciation times by 1. That becomes 1.2. That becomes the carrying value on 30th April X3 of 10.8 there. This 10.8 there that's revalued to 13 therefore that we've got the revaluation upwards or reserve, we put that into the OCI. We take 13 minus 10.8, that becomes 2.2 million. Yeah, if you want to know about the accounting entries, of course that's related to PP&E. We increase up the PP&E by 2.2. We always have the debit and credit the OCI of 2.2 million there. All right. Now, I will say that as a result of it, that the depreciation has increased because instead of depreciating the PP&E using 10.8, but now we're using 13, which means that 2.2 increase in PP&E would increase depreciation, not saving that. So it just calculates the increase in depreciation. We take that 2.2 million over, because 1 year has passed by, the remaining of 9 years. Okay, so always see the remaining years in our denominator, in our calculation. That being, I mean, we can round it to be 0.2 there. Okay. Now, the increase in depreciation, all we can do is that it's our accounting policy to make the transfer of the excess depreciation. So this means that, remember this rule, for that 0.2 here, we always debit R credit retained earnings, or RE, of 0.2. RR standing for the revaluation reserve. We reduce that and putting that to the retained earnings, which means that the shareholders will not suffer as a result that we revalues the property upward. Their dividend will not be affected. And that's why we increase the retained earnings, because we pay dividend out from the retained earnings. But trust me, you don't really need to know this. So next time when you see the increase in depreciation, always remember debit RR, credit RE. You can even slot that into your Excel. Yeah, it's fine. Right, 1 year later, PP&E revalued to 8. So which means that we'll account for the latest depreciation basing on the new costs of 13. There'll be no residual value here. The remaining years will be 9 years. So the new depreciation worth of 1.4 there. The carrying value on this date, X4, becomes 11.6. It's been revalued downwards to 8 million. That's why there's a decrease in value of 3.6 there. Alright. I'll call it as the impairment. Of course. Now, how do we treat that 3.6? I mean, in this paper, you don't really have to score the full marks from my perspective. Yeah? Because our aim is for a pass. And that's why when you see the impairment of PP&E, you simply credit PP&E of 3.6. If you're not sure about the debit, just to put that into the P&L as the impairment of 3.6. But I can tell you that, well, of course, the credit's right, debit's wrong. It's fine. Just put them there. But if I were to correct it for you, I will say that you will need to see the previous OCI as a starting point of 2.2. At the same time, a reversal of 0.2 there. And that's why you will need to reverse the previous OCI. You take that 2.2 and take 0.2 out, and you need to reverse 2 million as a starting point. For the remaining balance, you can put that into the P&L as the impairment of 1.6, and that is the accounting entry. They need to understand that. Which means that, remember, without the upwards and downwards, we'll need to remove all the previous OCI and leaving the balancing figure going into the P&L at the end. That's very important. Make sure that we are ready for that. How about the 3.4? Again, field company again. Yeah, I love this question. Now, the field again. Question called field. 6 marks, about 6 points in there. Right. Now we're told that we estimate the piece of mining needs to be reconditioned every 2 years. Okay. As a starting point, the recondition every 2 years, this means that we need to depreciate over 2 years, each and every time. When the new, I will say that equipment, replacing the old one, per the ICE number 16, that needs to be capitalized. Okay, now 2 points are there for one sentence. The cost of 2 for parts and 1 for the direct labor for the OEM employees. So which means that the total costs of 2 plus 1 worth of 3 would be directly attributable to the equipment. Which means that all the 3 million needs to be capitalized as PP&E. The directors are proposing to create a provision for next reconditioning, which is due in 2 years. Oh, this means that I would say that provision usually for decommission however, in this particular case, we will need to see whether or not there will be a probable cash outflow, that we will need to spend the money out, yes, because the directors propose to recondition it and incurring additional costs. Whether or not there will be a present obligation for it. We're told that no legal obligation that we have to do it. That's why this is not met. So even though the expense can be reliably estimated, I mean, if you've covered the ICE number 37 provision accounting, you know what I mean. I'm trying to say POR criteria there. I'm not going to be surprised you at the moment because I will cover the standards in depth later on. But just to give you a flavour that the director's proposal cannot be proceeded with. So our conclusion is that we can't recognise the provision liability as a result of it. Okay. Application 5. The PP&E with the conceptual framework with materiality concept. we're seeing that discussing it, the accountant has been reviewing the financial reporting processes and recommended that all purchases of PP&E below $500 should be written off to P&L, and this will reduce time and costs in doing so. Now, when answering this part, I always have my own framework in structuring the answer about materiality. Now, just follow me. Of course, I will detail that later on in our subsequent courses. Now, the question is called calendar. Of course, it's the past exam question, just to simplify it for you. And you can use this approach in future exams. Firstly, 1, 2, 3, 4. These 4 points you will need to raise to the examining team. Firstly, you will need to tell what's material. Material, which means important. Here, of course, less than $500 is immaterial. By amount. But you will need to say that, is it really material? Which means that although by amount it's not material, but if you've got repeated purchases, that for example, they split the 1 million PP&E into many and many pieces, that with each less than $500 by not recognizing it as the PP&E, and of course that is material by nature. Because in essence, the total amount will be material. And then you will need to consider how to present it. It's okay to consider the time and costs of preparing your financial statements is totally acceptable from the ISB's point of view. But you will need to regularly review it to find out the substance of a transaction. And therefore, it's my final point, because it's 5 marks here, and my conclusion is that if for small purchases and not material by nature, it's okay to simply write them off as the P&L expense, because it's like we buy the chair and desk each and every time. It's fine not to recognize it as the PP&E, is fine if the amount is quite small. Now, I think it's fine so far. We've covered 3 chapters already. These 3 chapters, not on the surface, not from your previous studies point of view, but it is in-depth coverage of these 3 chapters, covering huge amounts of past exam questions so far. I would highly recommend you to go through more of the past exams before we move on to the chapter 4 of our studies. And I look forward to seeing you soon in our speedy tuition course in the next section. Happy studying. Bye for now.
APC, accounting for your future.
Now welcome back to the final section of our financial instruments section. I will say that we are nearly there. There are only 2 remaining topics. Firstly is the credit losses for financial assets. Now, what I mean by this is that when you lend money to others, there might be a possibility that you can't get the money back, which means the default risk. Now, we are looking at solely for the situation when you lend money to others, which means that you invest in debt instruments resulting in potential credit losses. Of course, the accounting entry will be relatively straightforward. All we do is to debit P&L. All right. Now, that P&L would just be the credit loss, or the impairment, if you like, expense. Now, usually we put that directly into the investing section because you buy or lend money to others. Except for a situation that you are a bank, that is your main business activity is to lend money to others, and that's why the P&L will be going into the operating section. But most likely it's the investing one in the exam. And we credit the allowance, or we call it as the loss allowance. Think about it, it's like your receivable that somebody's not going to pay you, and that's why that you provide for the expense and to credit the allowance for doubtful debt. And that's just to be the similar situation here. Now, when we are talking about the credit losses here, we are talking about the amortized cost, or the fair value through OCI, investment in debt. Make sure they're ready. How about for fair value through P&L stuff? Well, as you name it, it's the P&L, and that's why any sort of impairment would directly or automatically go into the P&L already. And that's why we don't apply this model here. Now, this model is called expected credit loss, which means that we would expect that the event may go through stage 1 to 2 and finally 3. Now, stage 1 is what I mean by the 12 months expected credit loss, which means that in the upcoming 12 months, what will be the probability that you end up with a loss? You times them all together. For example, that will give you $5, for example, and you simply debit expense and credit allowance of 5, or loss allowance. That's it. Now, stage number 1 is what we may expect. I mean, if the credit risk did not increase significantly, which means that there will be no clues about the client's company that it may default on its payment, even though there might not be any clues on that. According to the prudence reason, we still have to provide for that journal entry. However, if there's clue that the client's company's credit risk increased significantly, now usually that we've got the presumption that the client takes more than 30 days of not paying us, which means that the client should pay us, for example, 20 days later. And after 20th day, that waiting for another 30th day, which means at the end of 50th day, that we still haven't received the money from a client. So that will be a clue that the client credit risk has increased significantly. However, we are still guessing how much money that the clients may not pay us. But at the stage number 2 here, we call it as the lifetime rather than 12 months expected credit loss. And that means that the probability may be a lot higher than what we estimated before. And we times by loss, the calculations just to be the same. So for example, if you calculate that to be 30, so we need to provide for an additional of 25, basing on $5 we've provided before. But here's the rule that the presumption of over 30 days can be rebuttable. This means that although it's over 30 days, but if it proves that the business credit status is absolutely fine there, we can still stick to the stage number 1, 12 months expected credit loss. Absolutely fine there. Now, when we lend money to others, we will get the interest income. Of course, we put that into the investing section. But how can we calculate that investment income? I will say that we would like to use the gross amount before deducting any sort of loss allowance. and timing by the original interest rate, and that's all we can do. Gross times by the original interest rate. However, if it reaches to the stage number 3, that means that the client's provided you with objective evidence that the client may not pay you. So that's why, again, you will consider the lifetime expected credit loss. But that is the stage number 3 lifetime, not the stage number 2 any longer. So what you need to do is to write down the investment in debt, for example, that may be a receivable, to the balance expected to receive, rather than considering the probability. For the subsequent interest income, we cannot times by, basing on the gross amount any longer. We will need to base on the net amount. Okay? Because we need to write down the amounts that we cannot collect and times by the original interest rate, unless that the loan term has changed significantly. So for example, we'd like to charge you another rate. Unless we're told about this, we need to use the original rate. Now, as you can see there, 3 stages, make sure that you are ready. So usually, the loss allowance, we will show them or present them separately against the investment in debt. Which means the investment in debt being 100, loss allowance being 10, and that will give me the net amount of the net investments in debt worth of 90. So we tend to present them separately. Now, seems a bit scary. How about for receivables, that whether or not there's a simplified version that we can do such things? Well, in real life, the answer is yes. You may have seen that if you're working the finance role in real life, that we always use the provision matrix here. So basing on the outstanding balances, for example, the 2001 to 30 days due, the default risk of the probability of 1%. So instead of timing by the losses, we time by the the receivables balance, and that will give me the loss allowance or the allowance for doubtful debt, and that's how we do it. It's absolutely fine though. That's all you need to know. But I know what you're thinking, Steve. What you're talking about? It's time to integrate what we've learned into these very good questions that are created for you. That's the credit loss. Now, we chose the loan is $1,000, so that will be the gross amount. So we need to compute the interest income on that, okay, from the stage number 1 and 2. Now, the bank, okay, so this means that we are the bank. Our main business activity will be to provide finance. And that being the case, any sort of P&L related to what we've seen in losses, that we put that into the operating category. Okay, that's a special rule. Unless that you are the normal company providing loan to others, and you provide that into the investing section. Now, the bank thinks that only 5% chance of default, and if that happens, it will lose 100. Now, of course, that will be in a stage number 1, which means that 12 months expected credit loss, because the risk not increased significantly. So we used probability times by loss. 5% probability will lose 100, and that being $5 there. We simply debit P&L. Here is in the operating section of 5, and credit loss allowance. So I will use allowance for short of 5. And that being the case, the interest income that we can still receive will be basing on the gross amount of 1,000 and times by the interest rate. or the original interest rate. Now, the original interest rate is for 5%, okay, so the next 5%, that being 50. Now, the $50 will debit bank, they will receive the interest income from another entity, and to credit P&L of 50. Okay, and that's all we can do. Now, at the end of 20x7, so we're told that getting risky is now 40% over the life, and the expected loss for default will be 300. So this means that credit risk increased significantly. Okay, reaches to stage number 2. Now, reaches to stage number 2 is where risk increased significantly, and that would be the stage number 2, or the lifetime expected credit loss here. Again, we take probability times by the loss if a default happens. So considering the whole lifetime rather than the next 12 months, only 5%, but now it's 40% on that 300. That being 120. Because we've provided $5 before of the allowance, and that's why we'll need to debit 120 minus the previous 5, 115 here, and credit the loss allowance to increase up the loss allowance by 115. Now again, we receive interest just to be the same as what we've seen before. We debit bank and credit interest income worth of 50, okay, basing on the original gross amount. Business not been objective evidence happened. But when we reach the stage number 3 there, we're told that borrower misses the year's 3% interests, but we still accrue it, that the party did not pay me that 30. So the gross amount now becomes $10, $30. But basing on the stage number 3's objective evidence, that we estimate we can only recover $600 in total. That means that will be a stage number 3, is the lifetime expected credit loss. So we will need to take the gross amounts now of 1,000 plus 30, of 1,030, and minus the amounts we can get, or we can recover, only for 600. And that being the case, we'll impair by 430. All right, and that's all we need to know. Now, for 430, we'll provide for the P&L allowance. How much do we provide in total? First year of 5, second year of 115, which means that 120 is that we provided. So this means that the additional one, we debit P&L, 430 minus 120, that being 310, and to credit allowance of 310. Okay, that's the starting point. Now, I will say that after writing down the investment in debt, the net amount, how much that becomes. Think about it. Think about it. Originally, 1,000 plus another 30. Write down 430. The balancing figure, or the net amount, will be 600 there that we can get. So that's why, for the interest income that we can get, will be based on the net amount times by the interest rate of 600 times by the original interest of 5, that being 30. So we debit bank, credit P&L worth of 30. Move on to the next one. Okay, the question called William. It's related to fair value through OCI, credit losses. Now we're told that you purchase a debt instrument or lend money for 1,000, the carrying value is 1,000, but the fair value fallen to 950, and we are told the expected credit loss is 20 there. Now the rule for it will be this. It's simple. This is the fair value for OCI debt instrument. Firstly, that from 1,000 down to 950. That's why you will need to credit your investment in debt, fair value for OCI, worth of 50. The expected credit loss will always go into the P&L of 20. So now, because that's related to the OCI, the balancing figure would go into the OCI. We debit the OCI on that. So make sure that you're ready for it. Another one, from the past exam, that required a calculation discussion of how the bonds should be accounted for in the financial statement for 20x3, 20x4, including any impairment losses. Wow, 11 marks there. So that's why stating a bit of theory would be fine there. But let's read through the case. Now, in X3, that we purchased 10 million 5% bond, I will say that that would be the gross amount. And repayable in X6, which means 3 years later, the effective interest is 8%. Now we use that effective interest to do the subsequent measurement. Now the model is to collect cash over the life of the asset. So it seems to me that it is at amortized costs. Now let me put them down before we move any further. Now this question is called Hummings. As a starting point, this is at amortized costs. Because when you read through the case later on, the cash tests, you collect interests and the principal. At the same time, the business model is to collect all this interest and principal. So that's why, for the subsequent measurements later on, you will need to base on the years, opening balance, easy, or the effective interests, coupon interests, which means the interest written in the contract, and closing balance there. The effective interest using 8%, the coupon interest using 5%. Now I will say that because it has impaired, because on this date, the bond to be low risk 12 months expected credit loss will be 10,000. Now I will say that 10,000 will not affect your subsequent measurements, because that 10,000 will be shown separately when we present the investment in debt. So that's why we still use that 10 million as a starting point to do the subsequent measurements up to 20x4. So which means that from the year 1, the opening balance of 10 million, and then with times by 8%, the effective interest being 0.8 million, and we minus the coupon 5% times by 10 million being 0.5 million. That being the closing balance of 10.3 million. And of course, you can say that the effective interests, you will need to debit the investment in debt of 0.8 and to credit the P&L of 0.8 million. Of course, for 0.5, you can perform another journal entry as your next point. Is when you debit the received bank and credit investment in debt instrument of 0.5. But now it's time that you talk about a bill of 12 months expected credit loss. You take the probability times by the loss if that occurs. So in this particular question that the examining team has given you directly, that has been 10,000. So the next points that you can write is that 10,000, how do you perform the journal entry? Yes, debit P&L and credit loss allowance. And that's why it does not affect the previous subsequent measurement. But I would wish to show the net amount at the moment. So when you talk about, for example, the presentation requirements in your SFP, you can say that we've got the investment in debt, the carrying value being 10.3, and then the loss allowance being, 10,000. I don't want to convert that into the $1 million anyway. So you can have the net amount of the investments in debt. All right, now moving on. We're told that next year that the company paid the coupon, but the risk deemed to have increased significantly. Okay, so this means that it's not the objective evidence. So which means that would be the stage number 2. Lifetime expected credit loss is not objective evidence at the moment. So that's why when we calculate that number, we'll take the percentage times by the losses. And surprisingly, that we're told the present value estimated to be 462,963, and the probability of default is 3% here. So this means that we take, we may collect 462,963 and anticipated no further coupon to be received, only a proportion of the nominal value of this bond to be repaid, and the present value of this cash shortfall would be this one, and the probability of 5%. Which means that, all right, so we have got the loss worth of 462,963 with the probability of 3%, plus another shortfall 68, 58, 70. With the probability of 5%. So, plotting them all together, that becomes 356,825. So, what we need to do is that because we just debited P&L worth of 10,000 and loss allowance of 10,000. Now, from 10,000 up to 356,825, that has been an increase of 346,825. Okay, we need to use Excel anyway. The increase amount would debit P&L and credit loss allowance by this amount. Now finally, when you show that in your SFP, the net amount will be updated to be the previous investments in debt and to minus the total of the allowance 356,825. That's all you can do. Of course, when you comment on the interest income, if you like, still that basing on the gross amount times by the original interest rate. And that's all you can do. Now, if you're happy, I think it's quite fair that you pick up every point in the past exam. I don't think that will be a problem for you. Who knows? Anyway, right, let's move on to the final topic. I must say that this is the final topic. I find it to be one of the most interesting topics, but a lot of students struggle with that. But let's talk about something called derivatives. Now, derivatives, which means that the value of the instrument, for example, the futures forward, will be deriving from what you're currently trading. Now when you go to bank next time, that you can ask the bank that how much money is that we need to pay if I were to enter into the forward contracts to fix the future exchange rate today. But the bank will certainly tell you, well, there'll be little or no investment at all. It's just to be the setting up the notification in your account when you receive the future money or foreign currencies that will be translated at the agreed rate today. Now the transaction will certainly be for the future, and of course the value changes per the underlying variable changes, of course. The forward contract, the futures contracts, that the price will fluctuate each and every day and each and every second. That will basing on the supply and demand for the underlying, for example, variable such as the commodity, let's say it's the apple or gold and silver and oil, alternatively interest rate, forex rate. So that's how you do it. The value will change per the underlying variable changes. Now, you may need to explain what the characteristics of derivative could be using these 3 points. I will say that derivative is something that deriving its value from the underlying item that you're trading and no investment, and that's all you need to know. Now, reason why we use derivative. Think about it this way. I always give this example to my student that if you want to sell apple, of course somebody will need to buy apple to make them becomes the apple juice, for example. I would like to sell at $5 at some point in the future, and you would like to buy at $5 in the future. We don't like change, so we tend to lock the price today. But how? Well, without derivative, without futures contract, you can't do it, because that will basing on the supply and demand at some point in the future to determine the apple price. So therefore, the clever idea works like this. We've got the futures contract. Because I'm the seller, I will also sell the futures contract at $5. You're the buyer. You will buy the futures contract, okay, not future, but futures, at $5. Now, let's look at the magic. What if that in 3 months' time per apple, the price had decreased to $3? Now, if that's the case, then I will say that from a seller's point of view, in the cash market, it has lost $2. Do you agree? Because instead of selling at 5, I can only sell at 3. However, in the futures market, for example, because I sell the futures first, which means we open the deal. And when we close the deal, we need to buy it from the open market. This means that I will sell at 5, I buy at 3. Wow. We sell more than buy. We sell income more than costs. I've got $2 there. So there will be the net position of gaining and losing nothing. This means that from a seller's point of view, effectively, that we are using futures contracts to fix the price at 5. How about from a buyer's point of view? Now the buyer in the cash market, because the price fallen to $3, instead of buying at 5, but now I can earn $2 of gain. However, because I buy futures at 5, but now when we close the deal, we can only sell at 3. We spend 5, but we only gain 3. Wow. We lose 2. That being the case, there's nothing, which means the buyer has locked the price at 5. And that is what the derivative or the futures contract look like. Now, hopefully that you're happy. The reasons why we are using derivative is because from the previous example, I'm talking about hedging. What do I mean by hedging is that we've got transaction in the cash market, and that's why we have transaction in the futures market to offset against the gains and losses with that. Net them off, in other words. But some of the investors may not really sell Apple in the open market, but only to trade the futures contract, which means that it's just to be a gamble. As we can say that we have ignored the cash market. And here, if you gamble in the correct direction, you can earn 2, but you will lose 2 if you gamble in the wrong way. And this is what I mean by speculation. Only the hedging instrument. Now, the instrument is the contract. Hedging which means to offset, and it's like the derivative. So which means that we are talking about things like futures, options, swaps, and forward. But most of the exam questions will be focusing on the hedging purposes. So which means that we've got the hedging item, which means the hedge item is like the Apple in the previous example, or other commodities. Alternatively, having the hedging instrument, for example, for the futures contract. Now, before we move any further, let's think about it. Let's think about inventory. Now, the Apple is like the inventory. Per the IAS number 2 inventories, Apples cannot be revalued upwards, which means inventories can never be revalued upwards. But here, as we can see in the cash market, that we are actually, as you can see, that we are revaluing the inventory upwards from a buyer's point of view, because that's a gain. Now, the only way that we allow this to happen is that we perform the hedge accounting. Without hedge accounting, the inventory can never be revalued upward. Now, the reason why we allow inventories to be revalued upwards is that we allow it to use the gains or losses to set off against the gains or losses in your futures contract, which means the hedging instrument. And that's why avoiding accounting mismatch. Because if you were to enter into the futures contract, and the futures contract, as we can see, incurring substantial loss from a buyer's point of view, if that loss is not hedged against with the particular inventory value going up, and that would worsen the performance of the business. And that's why, in this particular situation, we allow the inventory to be revalued upwards. But here's the thing. If you were to do the hedge accounting, you will need to meet with these 3 criteria. Firstly, common sense, you will need to document them. You will need to define what the hedging instrument and the hedge item would be. And what will be the relationship? The relationship, as we can see there, it could be the fair value hedge. I remember in the very first section that we talk about fair value hedge already, when we talk about inventory. It's something that existed in our financial statement. We've got a value in there. We are afraid that when we sell them off, that the market price will change. But it does not really affect the price that we pay for that inventory any longer. The reason is we've bought that already. We are very much care about its fair value or the market price changes. And that's why in hedge accounting, type number 1 is the fair value hedge. Another type would be, or another relationship would be the cash flow hedge. Cash flow hedge really talks about that we are afraid that when we buy the inventory at some point in the future, we may be spending more money because we haven't bought it yet. Finally, if you're operating overseas, that's not only you've got the foreign asset, but you also take out the foreign loan to offset against the change in foreign asset value. And that's what I mean by net investment in foreign operation. Now, one of these 3 relationships needs to be there. And finally, you will need to pass the effectiveness ratio tests. So that being the case, for example, here, either from a seller or the buyer's point of view, if I were to take the gains and losses divided by one to another, and that would be 100%, because 2 divided into 2. It's the perfect hedge. It's falling between 80 to 125% there. Now, let me give you another example. What if that in the futures market, we've lost 100. In the cash market, we've gained 50. What do you think? I would say that that's a huge loss. If it is vice versa, that would be a huge gain. Is it protecting the item? The answer may be no. The purpose is not to protect the item at all. Because if you take 1 divided by another, and that would be 200%. If vice versa, that taking 50 over 100, that would be 50%. It's 50 to 200%, not falling into 80 to 125%. Now, we're saying that when you're hedging something, that should be effective, that should be demonstrating the fact that you are protecting or offsetting the gains and losses from what you have in the cash market and in the futures market. But if you end up with substantial gains and loss in one particular market, I would deem that that would be the speculation purpose rather than the hedging purpose. So that being the case, that if you're not demonstrating that you've got or met with the effectiveness ratio tests, that you should stop using hedge accounting. Okay, now, Thursday, let's talk about speculation. Now, very straightforward indeed. The day one, when we enter into the agreement, we will look at the fair value. So if you are the buyer, always be in the fair financial asset, because you've bought something. If you're the seller, because you want to get the options contract, for example, or the futures contract, you can either acting as the buyer or the seller's point of view. The seller sells something to you, and having the liability when you exercise it, I will compensate for you the losses. So we'll need to recognize the financial liability at P&L. Now, at the year end, any changes, directly put that into the P&L, into the investing section, and that's it. But bear in mind, in practice, that if you're hedging against not for commodity, not for inventory, but in the exam, very likely is to be inventory. But in practice, that may be hedging against the interest rate. Now, the interest rate is for financing, and that's why the P&L changes would go into the financing section. But I don't believe that the examiner is mad that asking you so much depth in the exam. So no worries for that. Anyway, for banks, of course, into the operating section, but you simply ignore that anyway, putting it to the P&L. That's all you need to know. Now, here's the funny note I would like to share with you. Sometimes the transaction price may be zero. Now, especially that you're dealing with the swap, for example. Now, when we price the swap, I mean, in other papers, especially in financial management papers, that you can see that we will need to make sure that the two legs would just be the same value, okay, at the time that we enter into the swap agreement. Now, for example, that the company may enter into the swap agreement where the interest rate is higher than the current market price. The reason is I would like to pay higher interest rate later, but I would like to get cash from you to compensate for my losses. So that's why that usually I can get $3,000 at the very first start to compensate for my losses, that I will pay higher interest rate. So we will recognize the financial liability of $3,000 there. So even though that the transaction price being zero, but in essence the monies that I can get will be $3,000, that we use that to price the fair value of the financial liability in day one. So make sure that you're ready, that the fair value does not always be equal to the transaction price when we deal with the derivative. But let's put into practice for the speculation here. Now, the accounting treatment. Now, let me just write out the question name, as always. Speculation. It's a starting point. Now, we buy one call option. It's an option that we can buy at a low price at some point in the future. To purchase the commodity X, all right, at $100 at any time, the premium that we pay on day one is 4. Okay, so that's the fair value. So, because that's the buyer, day one, that we debit the financial asset into P&L worth of 4, and then we will credit bank worth of 4, because that's what we pay for the premium that we enter into the options contract. Now, the fair value at the year end was 6. So that being the case, 4 to 6, an increase of 2, debit financial asset fair value for P&L of 2, and credit P&L in the investing section worth of 2. Now, we sell for 12, okay, later on. So when we de-recognize it, we sell for 12, so we debit bank of 12. And we credit all the financial assets that we recognize up to this date of 6. And we credit the P&L as the gain on disposal or de-recognition of 6 as a balancing figure here. Moving on. Now let's talk about the hedge accounting. 3 types. Type number 1, that we are afraid of the market value changes. Now that commonly exists where we have hedge items such as the fixed rate debt, which means that the interest rate fluctuates. That does not really affect the monies that we pay for, because that's the fixed rate. So we pay at 3%. So even though the market interest rate increases to 5%, that does not really matter. We still pay 3. But we are afraid that when we price that debt, because we would like to use the coupon sitting in the numerator over 1 plus the effective or the market interest rate sitting in the denominator. If the denominator increasing, of course the price would change. And that's what I mean by the fair value changes. Inventory that we've bought, and also the binding contracts that we need to buy inventory at a fixed price at some point in the future. I would say that it's the firm commitment. It's also called the executory contract, as we've seen before. Because the price is fixed, that we will pay $10 for that inventory, even though that we haven't exercised that contract. But what if, when we buy it, that the market would discount that inventory to be 8? Well, effectively, that we should have bought at 8 rather than 10, but the cash flow does not really matter because it's fixed at 10, but the market value actually changes from there. Now, what we would do is that we will match the hedging instrument's value changes into the P&L with the hedge item changes in the P&L, and that's all we could do. When we settle the transaction later on, the hedge item, we do nothing in there because we've bought it already. Or if that's the binding contracts to buy inventory at fixed price, that we will buy it later on. Alright, for the hedging instrument, for the financial asset liabilities, that you convert them into bank, putting the balancing figure into the P&L. Now, as always, let's deal with the 10.15 fair value hedge question. Before we move any further. Now, we are told that we buy copper one time at 1400. On the same day, we buy the futures 1568. Now we'll say that the hedge item is copper. The hedging instrument to open the deal that is all about the futures contract. And we document that, and because we bought the copper, the relationship will certainly be the fair value hedge. So we'll need to see whether or not it meets with the effectiveness test ratio. As we can see there, the price changes the spot price up by 100 from 1400 to 1500. So by $100 there. For the futures prices, you can say you buy 1568, but now it's 1480. Now 1480 minus 1568, that being minus 88. Now what you could do is that you will take 1 divided by another, that being 113.6%, falling into 80 to 125%. So that means that we can use the fair value hedge accounting. So all we would do is that for the P&L, for the $100, for the copper, we simply debit inventory and credit P&L worth of 100. And for the hedging instrument, on the other hand, because you bought it, and that would be a financial, usually that would be a financial asset there. Okay. So all you can do is that you could debit P&L and credit the financial asset worth of 88. So that offsets against that automatically. Next one is fair value hedge for the OCI. Let's do it together. Now at the year start, the company purchased equity instrument 900,000. The fair value changes will go into the OCI with the futures contract. Okay. Now the item here is that you buy shares, which means the investment in equity instrument. The instrument here, you're using futures contract. And the fair value of the shares fallen to 800,000, which means down by 100,000. And the fair value of the futures had risen by 90,000. Now, if you take 90 over 100, that would be 90% of the effectiveness ratio tests. So we can use hedge accounting because we've bought the shares already, and that relationship will be the fair value hedge. We've got the hedge item and hedging instrument, we documented that. Okay, so that's how we do it in a working paper in real life. Okay, but with a bit of narrative, and that's fine. So we performed the double entry for that. And for the shares, because it's reduced in value by 100,000 there, so we credit investment in equity instrument and debit not the P&L any longer, because that has been designated at the start at OCI. So we debit OCI of 100,000. So therefore, as the futures contract, we can also go into the financial asset worth of 90,000 and putting that into the OCI to match against with the change in the OCI, because the purpose of the hedge accounting is to avoid accounting mismatch. We cannot put one in OCI and one in P&L. Final example. We're nearly there. Trust me, we're nearly there. It's the firm commitment, which means the executory contract. Now, the company has a firm commitment to purchase machinery next year. At the event, because of the exchange rate movement, the cost to purchase is risen by 100,000, and the gain on the futures contract 95%. Now the item is the executory, you can use whatever names that you want, contract, it's fine. The price is fixed, but the market value changes. The cost rising by 100,000, so the value decreasing by 100,000. And the hedging instrument, here what we are using against the futures contract by 95. Now the basic math telling me that 95 over 100, that would be 95%, falling into 80 to 125% effectiveness ratio tests. So that being the case, that we are afraid of the market value changes, and the relationship would certainly be the fair value hedge. So all we do is that, although it's for machinery, but for the firm commitments that we haven't bought it yet, and therefore for the 100,000 we will debit the P&L and credit the firm commitment liability by whatever liability names that you want. Okay, so this liability value worth 100,000 would just be the temporary account. Okay, so we need to net off any sort of purchases that we made. Okay, later on we make that purchase. The futures, as we can see, that we enter into that because we bought it, and that's why that we always debit the financial asset and to credit the P&L worth of 95,000. The second type of hedge accounting is called the cash flows hedge. And that means that we are afraid that the monies that we need to pay will change. For example, we take out the floating rate debt, and that's why if the future interest rate changes, that we end up paying more interest expense. Also, uncommitted but highly probable transactions, which means that we haven't confirmed the price yet. We haven't fixed that price, and this is not the fair value hedge. It's just to be the cash flows hedge. Okay, it's the probable transactions that we may buy machinery, but we haven't committed or signed the contracts to fix that price. So therefore, for the hedge item, no accounting treatment at all, because until it takes place, it's fine now. But the hedging instrument, on the other hand, that we will need to divide into the effective and ineffective portion. Now that's a bit different from what we've seen in the effective ratio tests of 80 to 125%. Because all we pick up is that for the effective portion, we put that into the OCI, because that's temporary, we are protecting it. For the ineffective portion, we put that into the P&L directly, because that's more like the speculation. Now, how can we determine that effective portion? Is that we'll need to take out the gain and loss, we pick up the lower value. The lower value, we put that into the OCI, and that's all we can do. Now, when we settle it, when the transaction takes place, that we de-recognize any hedging instruments, financial asset or liability into the bank, such as what we've seen before. But for the previous OCI that we recognize for the effective portion, we can either recycle or to reclassify that into the P&L, or to offset against the asset value when we purchase the asset. Now, let's look at the question here. Now we're told, now let me write it down firstly. The question is for the cash flow hedge. told the forecasted sales in a foreign currency is expected with a loss of 100 as a result of the changes in forex rate. And we take out a futures contract and the market value rising by 118. Okay, now what that means is the item here is just to be the forecast sales that we are looking at the forex rate. We didn't sign the contract, we didn't confirm the value, and we expect to lose 100. How about the instrument? Now the instrument, on the other hand, is that we took out a currency futures contract. Now the value has risen by 118. Now if you take 118 over 100, that being 118%, falling into 80 to 125%. So that's effective. We can use hedge accounting. The relationship here is the cash flow hedge. So the next one that we need to do is that we need to find out the effective and the ineffective portion. Basing on 100 and 118, which is lower? I will say that 100 is lower. 100 is lower, that would be the effective portion. So this means that we can use all the gain of 118 to offset against that loss of 100. So the 100 is effective because all being protected, leaving the rest of 18 not being protected. So that's why the accounting treatment only for the instrument here of 118. So that we are debiting financial asset of 118. Now, because it's selling things, that you can say that we can debit financial liability. It's entirely up to you. It's fine there. But more importantly, that we will need to credit, firstly, the effective portion go into the OCI worth 100, and the ineffective proportion would go into 18. Okay, so that's all we can do. Now, at some point in the future, that if the sales revenue, actually decreasing by 100, but my futures contract increasing by 118. So that being the case, that when the transaction actually takes place at some point in the future, that we can recycle or to reclassify the OCI by debiting the OCI directly credits the P&L worth of 100. So the profit can go up by 100 to offset against the sales revenue falling by 100, but profit go up by 100, so we protect the situation here. Let's look at the exam question called Collat Company of 10.19 here. So it's the Collat Company. Let's do it all together. Now, discuss accounting treatment. Now, the Collat Company hedges commodity price risk in aluminum. Such transactions are classified as highly probable, which means that we haven't fixed the price today. So firstly, I will tell the examining team that the item is aluminum and the instrument, I will say that the purchases were considered highly probable before the natural disaster, but no longer expected to occur now. All right. Now the instrument can be any sort of derivatives. The second point I would say that is highly probable. This means that it's a cash flows hedge. And you will need to meet with a effectiveness test ratio of 80 to 125 par in order that you can do the hedge accounting. You can also say that the accounting treatment, the effective portion, they pick up the lower of gains or loss into OCI, and the ineffective portion going into the P&L. I think that's fine. However, one word that, because no longer expected to occur, this means that we don't use the instrument now to hedge against that future item. That qualifies as the discontinue the hedge. Now, when you discontinue the hedge, all you would do is that you will need to remember into P&L. Any sort of OCI finally would go into the P&L if you discontinue that, if you stop using that, okay, because of a natural disaster, for example. And that's why, as we can see from your next page, we have discontinuation of hedge accounting. Now, when do you discontinue that? Is it when you have no hedge item or no hedging relationship? So all you need is that any sort of things would directly go into the P&L, and any sort of financial assets will not be existed any longer. Now, let's deal with the 10.21 example before we move on to the final one. Now let's read through the case. The interest rate swap was used to hedge against that borrowing, something to do with the financing. So any P&L would go into the financing section. For the loan, we adjusted the fair value, there'd be P&L and credit financial liability, and the hedging instrument. We recognize the financial asset worth of 28. But the company wants quick cash and deciding to keep the loan to maturity, and that's why we discontinue that hedge accounting. So we need to reverse the hedge item P&L 30 and the financial liability, because we credited the financial liability worth of 30, and we debit the financial liability of 30, and to reverse that P&L worth of 30. That's a starting point. So subsequent measurement, because you want to hold it to maturity, so we'll need to use the amortized costs to provide for the finance costs from the beginning up to now, or up to the future. And for the hedging instrument, as we can see there, we want quick cash, and that's why for that 28, we will convert into bank worth of 28 and credit financial asset worth of 28. Because we haven't got any OCI at all, so we don't need to worry about to reclassify that into the P&L. Now, second one, it's all about the cash flows hedge. It's now terminated for the probable transaction in the future. So that's why firstly, for the financial asset, we convert that into cash. So we debit bank worth of 100, and we credit the financial assets worth 100. At the same time, because we've got the OCI worth 100, so we need to reclassify the OCI into P&L. Here, the P&L referred to as the it's just to be the highly probable transaction. So if that does not relate to the borrowing, and we will put that into the investing section. So if it relates to the borrowing, we put that into the financing section there. Now finally, I would say that finally is the net investment in foreign operations. So what that means is that we are afraid that when we invest our money overseas, that the exchange rate may change. And that's why, similarly, that what we've seen in the cash flows hedge, we'll need to divide into the effective and ineffective portion. So let's look at an example here. A invested in B and took out a loan to hedge against B's equity value because of the forex movement. And at the year end, we can see that what we've invested decreased by $100. But the loan value, because as you can see, the asset value decreased, the loan value would decrease. That means that we pay less liability. And asset reduces, liability reduces, of course equity remains the same. And that's how we utilize the foreign loan to protect against the asset. As we can see, the loan value has improved by 110. Now the starting point is, let me point this out, we will need to find out the lower value here, 100, 110, we pick up 100, go into the OCI as a starting point. And that being the case, the equity value decreased by 100. That being, debit the OCI 100 and to credit the investment in B company decreased by 100. But at the same time, because of our loan value has increased, we debit the financial asset worth of 100 and we credit the OCI to match against that worth of 100. But what about the ineffective portion? And the ineffective portion by another 10 has the increase in value, so that's why that we debit the ineffective portion worth of 10 into P&L and debit financial asset worth of 10. There you have it. So far that we finish off the whole financial instrument section here. I hope you're absolutely happy. I would say that it's a big standard, but it's fine. From next chapter onwards, we will be covering something that's more exciting, and I can't wait to see you very soon in the next section. Bye.
APC, accounting for your future.
Welcome to the past exam question from the ACCA Strategic Business Reporting, or the SBR, for the March and June 2023 exam question go through. Let's see the question called cut third company from the question 2. Now, as always, let's break down the requirements. Now, we have got part A, B and C within our exam. The best practice firstly is to copy the requirements into a word processor and break this down. Now, firstly, discuss, which means you need to put the words because in each of your points. How the advancement of the IT impacts on the ethical responsibilities of an accountant. Now, firstly, as the professional accountant, our responsibilities would be firstly to make sure that the control system of the client's company, of the companies that we are working in, will be okay, will be effective. And therefore, we can bring confidence to the shareholders or investors. Now, 4 marks here, there'll be no need to refer to any specific exhibits to answer part A. Right, but from my perspective, always link your answer with the case so you can see a big picture of why the examiner is setting the requirement like this. So in this exam, of course, 1 mark equals to 1 sentence, and make sure that you always follow that rule. Part B is to discuss the ethical issues faced by the accountant. Now, this means that we are always focusing on Mr. Imbrima, okay, this person, and the internal auditor. Okay, so we have got Mr. Franklin Ishwell. Okay, so there will be 2 guys here, and that's why we just split our marks, 6 marks. I would say that, okay, equals to 6 sentences again, and possibly I would be allocating 3 marks related to Mr. Imbrema and Mr. Franklin. I would like to split 2 marks in that. And of course, and any actions that you should take to address these issues, I'll allocate 1 to 2 marks or sentences related to the final part. So do remember that we have got 2 marks here. So when answering the ethical issues in the SBR exam, my top tip for this kind of requirement would be, firstly, always use the word because or as. So it will force you to think why you're going to be giving that point. The second element within each of the point in your answer is to be very specific or detailed. You can't say that simply, okay, so from the scenario like that, it seems that he's breaching the familiarity threats to objectivity and full stop. No. Possibly will gain 0.5 marks for giving that point. But in order to get 1 full mark for each point that you've made, it will be very important that you need to be specific. Okay, so we've got a clue from the case that we are friends or we have been an accountant for many, many years, and we are not really be very careful enough to check the details and so on. So this creates familiarity, threats to objectivity, that kind of stuff. Okay, so you need to be very specific, tailored your answer to the case. The best way from my perspective to tackle the part-based is always to focus on each sentence, okay, from the case scenarios, so you can link that and to comment on that. Part C, okay, is the traditional accounting treatment requirements. Explain the effect of the IAS 38 intangible asset and IAS 36 impairment of asset on the accounting treatment of the purchase of a company's procurement system and development costs, and in the financial statement for the year ending 31st December X8. So this means that A marks will be allocated for related to intangible asset according to IAS 38 and impairment according to the IAS 36. And as I said, my top tip for the SBR for the accounting treatment is to see whether or not the requirement is more than 5 marks or less than 5 marks. And here, clearly, it's less than 5 marks. Of course, we will need to, we need to follow 3 steps approach here. So firstly, is the general IFRS requirements, and then talking about the application, and finally the conclusion. So in this case, I would rather put 1 mark related to the IFRS general stuff, okay, talking about that, and I would like to allocate 2 marks related to application, and for the conclusion, I'll allocate the final 1 mark related to it. For the conclusion, yes, I always say to my students before that you can think about the correct accounting entry, you can think about the impact of financial statements, for example, the ratios, you can always bring the conceptual framework requirement in. Of course, if the errors are so huge, you can talk about the relevance concept. Within there, we have got the materiality principle to be applied. Now, let's see the case backgrounds. The Cathert completes a successful division within a multinational company called Herding Company. Right, so if you're reading the question like this, okay, you can always use the highlight function in the Excel. I'll show you how in a second. But more importantly is to draw a diagram or a picture so you are not mixing these 2 companies. So for example, within that group it's called Herding Company, and within there we have got a specific division called Cathert Company. Right, we are told the year end 31st December, we've got the following exhibit by clicking on that on the left hand side regarding the new system describing the purchase of the unauthorized procurement system, which means we're going to buy something, buy raw materials and so on. And it is by the Cathert Company on 1st August, which means before the year end. So always in this exam that you may be told about some sort of information that is after the year end. So therefore, the IAS number 10, it meant after the reporting period may come in. And here, it's not related to IAS number 10 at all, but we are focusing primarily on the ethical issue that we are buying this, which is unauthorized. Okay, it's not authorized by the head office, something like that. And the implications of that decision, so this means that we're going to be seeing that whether or not the purchasing decision will result in the financial performance being impaired of a company later on. Now, by clicking on the exhibit, okay, so you're going to be seeing that it's all about the new procurement system, right? So this year, the holding company, which means the head office, which means the parent company, something like that, upgraded the computerized system and to centralize its procurement processes. So the reason why the head office would usually centralize the purchasing option is to, for example, we are buying in bulk to enjoy the bulk discount in certain circumstances. So to decrease the purchasing cost for the company as a whole. All divisions of the holding company were required to use the same procurement system, and this is quite usual in practice, and I can certainly understand that. However, on 1st August, the divisional head of the cassette company, okay, now, the head is called Mr. Bookman, purchased a procurement system without authority. Now, you need to think about why this would be a case. So, we can certainly use the system provided by the head office or to be required by the head office and to centralize our purchasing decision and to make sure that we are using the approved supplier in all circumstances to decrease our costs and something like that. But why does the divisional head use an alternative system? You may be thinking about, well, there might be reasons that using alternative system, it would be more cost effective. It may be more convenient. It may be, yes, working with a particular group of suppliers that may decrease our purchasing costs for a company. Or the downside may be fraudulent transactions. Or maybe Mr. Bookman spends the money out to buy that system and later on the supplier may reimburse part of that purchase price to Mr. Bookman's own personal bank account. So yes, we can come up with different possibilities pop up into our mind. Now, moving on then, which is incompatible with other systems of a group. Right, there might be problems coming in. Now, when I'm reading the case, I would not simply read the case and then, okay, I'm the student and to tackle the exam question by referring to the knowledge from the textbook. I will not certainly do that. But it's very important that you think about a lot of reasons and possibilities popping up into your mind. So when you are reading the subsequent cases, you will find it much easier. Now, the new system is specific to the division and cannot be used by other divisions in the group. Right. Okay, now, I would say that if you're using a particular system like that, so how about if you're subsequently auditing or checking that system, there might cause a lot of problems because of the inconsistencies that you authorize the transaction and to contact with the external supplier and to making sure that price is transparent and something like that. Policies are quite different from systems to systems. Okay, so you're going to be thinking about whether or not there might be additional costs that you need to think about. Okay, so always bear that in mind. Mr. Bookman stated that the third division will use this new system to make purchases in the future, right, rather than the company's centralized system. Okay, so it seems to me that Mr. Bookman is trying to build his own world within that company, is to be an empire within that company. We're not particularly sure. As a result of using that new system, the third division developed a poor purchasing strategy. Oh, right, that's the problem. which resulted in unfavorable pricing decisions. So this means that this increases costs to the company. And of course, investors will suffer. I would say that why we need to have responsibility from the ethical side. Of course, firstly, we need to be responsible for the overall control for business because we are for example, the finance director, something like that, and we're the employees of the company. At the same time, why not? It would really impact on the confidence of the investors, and we need to think about that. Even though the third division has made purchases within the new system, it's not fully operational, right? It's yet fully operational. So this means that when it comes to Part C later on, that we cannot amortize it, okay? We cannot amortize the capitalized development cost because, it's not fully operational. So this means that it's not getting economic benefit in because it is incompatible with a company's centralized systems. Right. Now, what we are going to do is that let's answer the Part A firstly. So how the advancement of the IT impacts on the ethical responsibilities of an accountant. I would say that I would develop my own answer to substitute the examiner's answer because I think that students should write 1 mark equals to 1 point, and that will be perfect to pass the SBR exam. So I developed my own answer from a student's perspective and to help you earn marks in this paper. So Part A, I would like to show my answer such as this. Now, firstly, Mr. Bookman buy the system without permission. Yes, I quote it from the exhibit. Although, yes, the examiner tries to help students a bit further by saying that in Part A you don't really have to refer to any exhibit. So that's why I've got a quote here. And you can refer to as in the exhibit, but you don't really have to in a Part A. Now, it shows that the need that from the accountant's point of view, we always need to challenge the unauthorized decisions related to IT because that could be damaging, okay, to the business. So I would say that the first point, I would like to say, yes, why it's important? Because it's our responsibility to challenge any major decision that will impact on the company's control. And subsequently, we are told in the case that the strategy is quite poor later on from a purchasing side's point of view. This is why we need to identify and warn any practices that might hurt the company's financial term. So this means that we need to be responsible for the internal control of a business. So this means that you can always think about whether or not is meeting with 3 E's criteria. For example, efficiency, which means whether or not it's causing waste, economy, whether or not it's sticking with budget, and whether or not it's effective, whether or not shareholders would be happy about that. As you can structure this point in another way, okay? You can talk about efficiency, you can talk about economy, you can talk about effective, okay? So this means that poor purchasing strategy, so this means that it's not efficiency because you're wasting company's money. It's not economy because you're not adhering to the budget, perhaps. It's not effective. Perhaps you're buying something that's not good for the product quality later on. Okay, so from this point, you can restructure that into many different points, ideas, if you want. Now, the next point I'd like to write is that the new system, yes, not working with the centralized one, and what we should do is that we need to stay unbiased. So which means we need to be quite objective indeed. Because when the new technology or new system comes into our company, we do really have to be very objective in assessing that we cannot fully rely on the pricing information given by that system or captured by that system. We need to be very detailed and very cautious about any changes or any sort of information that are popping up in the system. And finally, yes, what we need to do is that within that case, it's our duty to protect the confidentiality and safety of the system, Because as we are told that firstly, we buy the system that is not authorized. So why you're buying the system without letting the head office to know about this? So possibly there might be reasons like potential errors, potential fraud, and perhaps the system is quite cheap, but Mr. Bookman later on may get the reimbursement from a supplier. It may be the corruption, that kind of stuff. So this is why it leads to the unauthorized change in that system. So we care about the safety issues of that. At the same time, we also care about the confidentiality. Whether or not the supplier supplying us with that system would certainly have measures in place in making sure that system is safe. If it's not safe, of course, our system information may be leaked to the third parties. So this is why we need to care about that. Of course, I've developed you with 4 sentences there, and of course the examiner's answer is absolutely different from mine. And yes, you can develop your own answer based on the points that I've said to you. So for example, based on the confidentiality, you say to the examiner why the system purchase is unauthorized, perhaps implying fraudulent transaction, and the supplier is not inputting sufficient budget into perhaps making sure the system functions correctly, leading to, for example, confidentiality issues, and the system data may be leaked to a third party. You can say that, okay? So different students would get different answer for the part A. I would say that from the marker's point of view, that the part A is quite straightforward, and when we are awarding marks to students, generous, okay, quite generous indeed. So as long as you are saying 4 sentences, so that will be absolutely enough there. Now, let's move on. Let's move on to the part B, talking about the ethical issues. Now, so we are told in this exhibit, we've got the accountant and the internal auditor. So we've got 2 types of persons that we need to be dealing with. Firstly, the accountant is called Mr. Brimmer. He's considering the impact of the poor purchasing decision and how to improve the control over the division. So it seems to me that you're only considering the impact rather than take immediate action against Mr. Bookman. And this is incorrect, okay? So it seems to me that maybe you're afraid that taking immediate action against Mr. Bookman, maybe you're afraid of him, something like that. We're not particularly sure. So we can comment on this, okay? You can copy that sentence and to comment on this. But a more viable approach, okay, from the examining team is that don't really just copy the whole paragraph or whole sentence, okay, to your answer. Yes, you can certainly do that, but the best practice is not to do it like that, but to summarize into your own point. Because I must say that some markers, when marking the script, they may not read your answer very, very carefully. So if you're copying the whole paragraph into your answer, it may be seen that you're simply copying the information from the case, and it earns you no marks at all. So even though you finally make a few words as your comment, maybe the marker cannot see this when he or she mark your script quite quickly, tick a tick, tick a tick, tick a tick for that, and skip your answer, and of course you will suffer. So in this case, developing my own answer, as we can see there, firstly I would say that Mr. Brimmer knows that Mr. Bookman, by passing the procurement system, a centralized system, but to purchase his own system, and faces the dilemma here and breaching the ACCA Code of Ethics by not actively confronting the issue. Okay, so it seems that there's not taking immediate action against Mr. Bookman. Okay. Now, However, it does not wish to introduce controls which Mr. Bookman feel are excessive. All right. It seems that he's afraid of Mr. Bookman, yes, because Mr. Bookman is a dominant individual who often puts pressure on him. Right. So it seems that, yes, I can draw a conclusion that the accountant is afraid of Mr. Bookman because of the intimidation threat to objectivity. So I would say that I will bring my comments as the first sentence, okay? Otherwise, when I'm making comments in the part B, that I don't want my answer be seen that I'm copying the case information only without making my comment at all. So I would say that he experiences an intimidation threat, so being threatened by somebody else. I would say because of us, okay, because Mr. Bookman's pressure compromises the objectivity. So which means when we are making decisions, we are not objective, we are not thinking about the standards, we are thinking about the personal stuff. Challenging the ability to act impartially or objectively in line with ACCA's Code of Ethics. Okay. Now, this is my second point now. So I would say that, yes, I would not simply stop from there, but I would give details to the examining team to explain one step further, okay, why this matters, because it's not objective. That's it. And of course, we are reluctant, or the accountant is reluctant to implement controls, okay, because Mr. Bookman's dominance. So this means that I would say that, yes, it's not objective because you're not sticking to a rule, but I've said that in the second point. I will not duplicate my points, and therefore in the third point, I would say that it's lack of integrity. So always think about this. I'm reluctant to do something. Yes, you may be afraid of others. You may be accepting the interest from others, which means intimidation threat or self-interest threat. Or perhaps you're not meeting with integrity principle. So these sort of things can be used interchangeably, so make sure they're ready. Now, I would explain things further. Lack of integrity, because it failed to uphold standard against managerial pressure. Right, okay, because I'm afraid of that pressure, I'm not acting with integrity. That's it. So I'm giving details about the reasons why this will be a case here. Now let's move on. Is that Mr. Bookman is on the management committee of a company to whom the internal auditor, Mr. Franklin, reports. Oh, okay. Now, the internal auditor directly reports to Mr. Bookman, and I'm the accountant. I'm afraid of Mr. Bookman because he's on that management committee. I'm afraid that my job will be lost. It's simply be the ethical dilemma here. And we've got the internal auditor also reports to Mr. Bookman. Right, Mr. Bremer has reported his concern to the internal auditor, which means the IA internal auditor reports to Mr. Bookman, and I'm the accountant. I report to internal auditor. The internal auditor reports to Mr. Bookman. Right. The internal auditor is the qualified member of ACCA and known to be a personal friend of Mr. Bookman. So it seems to me, yes, I can explain the familiarity threats to objectivity. At the same time, you know that Mr. Bookman has made the wrong decision. You should challenge Mr. Bookman, but the internal auditor failed to do that. So it doesn't meet with the professional competence and due care principle. Now, I would say that now the internal auditor, yes, familiarity threats to objectivity and favours personal relationship over professional body, and this is absolutely not correct there. At the same time, that undermines his competence because, yes, lead to overlooking or downplaying significant issues within the division. So this means that, okay, this decision made by Mr. Bookman may be 1 out of 10 issues that we found out. How about the remaining 9? So not really using the professional qualification i.e. the professional competence and to help with the investors, something like that. So yes, that's it. However, I will also to tell the examiner about the actions. Of course, firstly, we should guard against the ethical threat. We should eliminate or reduce those threats and maintain high standard, firstly, integrity, professionalism, or you can say about the 5 principles according to the ACCA Code of Ethics. Okay, up to you then. And to solve this, yes, seek guidance from higher authority. For example, raising this issue to non-executive directors within our board, or perhaps we should contact with ACCA and to see how we solve this matter. From the internal auditor's point of view, the independent review of the procurement practices will be very important, and to see whether or not you're selecting the suppliers on a fair basis. Okay, so you need to remove any particular personal biases at all. You need to remain objective in all circumstances. Now, I've written more than 6 points. 1, 2, 3, 4, 5, 6, 7, 8, but you don't really have to do that. In the exam, there will be no need for introduction to get these professional marks, but it's important to firstly to answer all the requirements, and 6 marks, 6 sentences, and secondly quoting a few keywords such as familiarity, threats, or objectivity, integrity principles, and that'll be absolutely fine and enough there. Now, the final issue related to the Part C is all about the procurement costs. And we're told that Herding Company's policy is to upgrade system for every 4 years, and the cost was 5. And there were additional development costs incurred of $0.1 million related to the payroll. And all of these costs has been written off to the P&L this year. So this means that firstly, this is not correct there, because I would say that you can explain in the IAS number 38 for the intangible asset, firstly, that you can say firstly, the definition of the intangible asset is just to be the asset without the physical substance. These are non-monetary. And to recognize as the intangible asset, it needs to be identifiable and controlled by the entity, and the cost can be reliably measured. You can say about that. And more specifically here, that is to upgrade the system. So this means that bringing something new, and that's related to the R&D. Okay, it's the research and development phase. And of course, we can always say to the examiner about the criteria that when should we capitalize that development cost as the intangible asset is where, I use my own mnemonic, is called user. Tim, who is the user of this computer, Tim is the user of this computer, and that's it. So this means that if the system can be used or sold by the business and generating future economic benefit coming into the business, which means, yes, it's commercially viable. And if we have enough resources to complete the whole development phase in terms of human and financial resources, and it's technically feasible, so this means that we can get the scientific report on that, and the management has the intention to complete the whole development phase. And of course, the expenses can be measured reliably, and what you need to do is to recognize as the intangible asset. And the third point, as the general IFRS quote, is that when should we amortize the intangible asset or the system, is when we are putting it into commercial production and we start amortizing it. So this is all you need to know. And of course, for the subsequent measurement, you can always think about whether or not we should impair that system, is where the useful life of a system is indefinite, which means we're not particularly sure how many years that we should use that system. Now, I would say that in my answer, created for you, is that following the 3 steps approach is that firstly, for general IFRS requirements, I've talked about the identifiable non-physical, okay, in terms of substance, which means we've got a piece of paper confirming that system belongs to the entity, but it's not being touched, such as the PP&E, property, plant, equipment. And applying to the case is that the $5.1 million, yes, we should capitalize as the intangible asset. But I would say that because the system cannot generate into benefit to the business right now, because we are subsequently told that previously that the system, is yet fully operational, okay, because it's not compatible with the centralized ones. So this means that whether or not we can generate benefit of that, this needs to be challenged. So I will bring this as a separate point and to see that applied to a case that the 5.1, it seems that we are not using it. So this means that it does not fulfill with the economic benefit criteria, so it would be okay to expense that. Now, I would say that if the conclusion, the correct entry, is that if it qualifies the intangible asset, yes, capitalize it and then amortize it when we put it into commercial production or commercial use. And I would say that another point is that the impact on financial statement, you can bring it as a separate point there, is that it will certainly affect the SFP and the P&L related to the recognition of the intangible asset, putting up the value of the non-current asset, at the same time recognizing the amortization expenses to make sure the profit is brought down. Now, the second one related to the ICE 36 is that they also doubt about the security of the system and potential short-term technological obsolescence. So it seems that we're not putting the system into use. So this means that whether or not the system or the intangible asset needs to be written down in value is that firstly, according to ICE number 36, you don't really have to quote the numbers, but the example directly gives you that. Now, firstly, for each entity, at each of the reporting periods end, we should assess whether or not there will be indicators indicating that the system will be impaired. That indicator could be from internal, or it could be from the external indicator. Internal, which means it's damaged, obsolete. External, so for example, is out of date, okay, and the government does not allow you to use that. So you need to compare the carrying value of that intangible asset with the recoverable amount. So which means from the entity's point of view, how it could recover that intangible asset costs through value in use, using it for long-term purposes, or fair value minus cost of disposal. Okay. If the value in use is 10 and fair value minus cost of disposal is 9, I would bring 10 into the recoverable amount. Okay. If the carrying value, let's say, is 5.1, less than recoverable amount, there will be no entries that needs to be done because it's not impaired at all. And I would say that applying to the case is that we are given the technological obsolescence and the security. So it seems that these are all perhaps the internal impairment indicators. And this is why it triggers or leads to the need for impairment tests, as I can say that. Now, what's my conclusion? I would say that based on the correct accounting entry or the impact on financial statement, maybe need to written down and expense into the P&L that needs to be recognized, otherwise we'll overstate that profit. Now, I would say that, yes, from the case, I bring additional consideration for the 0.1 million should also be capitalized if we determine that $5 million of a system that can be used later on. And of course, we increase the intangible asset value. At the same time, the $5.1 million that if we have capitalized it, but we still question about the technological obsolescence issues, that kind of stuff, yes, we'll need to write them down, and it will significantly affecting the reporting profit and, yes, materiality principle. And this means that we need to be very, very careful on that issue. Now, finally, let's see how we bring these using the computer, okay, because you're sitting the CBE exam nowadays. So firstly, yes, we've got a case background here. We have got the exhibit on the left-hand side. So when you are reading that exhibit, make sure you zoom in and to drag this and to make sure you can read every sentence of that. At the same time, you can copy the information by pressing Ctrl+C and Ctrl+V into your word processor like this. But more importantly is to look at the requirement firstly and to select, okay, all these issues and to put them into your word processor. And then trying to make sure that you know what the examiner wants. Part A, Part B, and Part C. But firstly, discuss how the advancement of the IT impacts on the ethical responsibilities. I would say that I don't like this word discuss, and I don't like the note of that, but you don't really have to cancel this, but saying to the examiner, okay, this is my heading, and I need to write 4 points to earn this 4 marks, so just leave them there, it's absolutely fine there. Okay. Now, Part B, discuss the ethical issues faced by the accountant. Okay. Now, I would copy this here, and the ethical issues faced by the internal auditor, okay, that's my second heading, and yes, that's important there. Okay, we've got 2 and here, and this means that we need to copy the subsequent one, and the actions to take, okay. Now, we're given, yes, 6 marks and 2, so this means that I need to write, when planning my answer, 6 sentences in that. And applies to Part C as well. Okay. Now, when we are reading the case, it's important that you notice that all the things that can be copied to get into your answer. Make sure that you copy into your answer, and don't just simply copy the whole paragraph. So, for example, the accountant considering this, okay, copy this into the question B. Okay, I'd like to make this point, is that the accountant considering the impact, okay, it's the accountant considering the impact, right, I would like to copy this. I would bring my point firstly that the accountant should take immediate action to protect shareholders' interests, i.e. to act with professional behavior, but the accountant, okay, change the word, but the accountant of Herdings considering impact of poor purchasing decision, and this is against the principle in the ethics code. Okay, now if you're making this point, of course you will gain full marks for these points that you've made. Rather than just simply copy the information without any comment at all, my advice is to put your comment firstly, okay, as the first part of your point, and that will be very important there. For each point that you've made, make sure that you leave a line, okay, that's important there. And for each of the headings, okay, just bold it and to underline this and change the first word capital, Any sort of copying information from a case, just leave them, okay? Just make sure that it looks absolutely clean to the examiner, and that's enough. Whether or not you can put the number next to that, absolutely yes, you can do that. Okay, so this is not a bullet point format because you explain them in full sentences, and this will be absolutely key for you to pass this paper. Right then, okay, I'm going to be stopping this recording now. I hope you're happy, and I look forward to seeing you in the next one. Bye-bye.
APC, accounting for your future.
Welcome. Now, for another company 25 marker question, starting with the requirement A. Discuss the acceptability of the company's decision not to record any liabilities for the roof collapse, which means the company is being sued, perhaps, in the consolidated financial statement. So, we are given 7 marks here. If any student is talking about the impairment of non-current asset, according to ICE number 36, there will be no marks for that, because the question specifically asks you that because of the roof collapse and somebody is suing the company, and whether or not we should record any liabilities. And of course, from the case that the management decides not to record any liabilities at all, so this is not acceptable perhaps, but this may be acceptable if this is on the early stage, okay, of the case. So according to the IAS 37, provisions, contingent liabilities and contingent asset, so we need to apply the correct accounting treatment on that. Of course, I would detail that in 3 steps: the IFRS requirements, application to the case, and making your own conclusion about the right accounting entry, or the impact on the financial statements, or the conceptual framework requirement. So make sure that 7 marks, 7 sentences. Part B, discuss the acceptability of the company's decision in the consolidated financial statements, number 1, to disclose a contingent liability for the estimated cost of redeeming the put options. Right, so what do I mean by put options? Don't be scared if you see this term. It's relatively straightforward. It's just to be an option to sell something at a particular price. It's what I mean by put option. But in the case later on, we will see that the company has written the put option, which means has sold the put option to others. So this means that if the buyer exercises the put option at some point in the future, from the company's point of view, it will have an obligation to exercise it. Okay, so it seems to me it's like the financial liability that we need to recognize. And yes, IAS number 32, the financial instrument accounting standards knowledge pops up into my mind. Okay, so making sure about the presentation part, we make this right. Number 2, to record the non-redeemable preference shares as equity rather than a compound financial instrument. Okay, so we are given 6 marks here. Again, these 2 requirements are related to ICE number 32. To recognize the compound financial instrument, we need to see that whether or not a contract contains both of the liability and the equity element in, and we'll see that later on. Of course, yes, we are given 6 marks here. Any requirements that is more than 5 marks, make sure that you follow the 3 steps very carefully. The 3 steps includes the general IFRS quotes with the detailed requirements in there, and application to the case, which I'll show you how in a second, and finally the conclusion part. My advice to be to focus on these 3 stuff: the advice to the company about the correct accounting treatment, and the impact on the financial statement, particularly for ratios, something like that. Alternatively, the marking team and the examining team of the SBR said that the conceptual framework requirements can always be quoted in your answer, and you will get reasonable marks by doing so. So make sure that you follow these 3 steps here. Now, as the final requirement is that, yes, okay, wow, IAS number 7 statement of cash flows tested here. Now we are given A marks for this 1, 2, 3 requirement. So make sure that in the CBE exam, I'll show you how in a second. First is to copy all these requirements in the word processor and make sure you use them as headings and write 8 sentences, okay, in total. Now, number 1 is to explain the importance and the distinction between classification of cash flows from investing and financing activities. So make sure that if I were you, I would like to use investing activities and financing activities as my subheadings. And within each of the subheading, I will need to tell the examiner, firstly, what will be the importance of showing cash flows in both of these headings. At the same time, the differences in that. Okay, so making sure that you write enough sentences. So if I were you, I would like to approximately allocate 3 marks at least to the part 1. Number 2 is to outline the circumstances where the cash flows may be reported on a net basis. Well, if you know about the accounting standards, I must say that the number 2 requirement, you can write approximately 5 sentences in there, but I'm sure that a lot of students are not quite familiar with the net basis here. So if I were you, is that, right, I would like to say about 2 possible points, okay, related to number 2, because I know that net basis is that, firstly, yeah, there are 2 easy marks that I can get there. So firstly, the cash flows from operations, okay, especially for the net cash flows from operations, yes, will be shown on the face of the statement of cash flow on a one-line basis by netting all these cash flows in. Alternatively, the cash flows may be net. For example, how about for cash and cash equivalents? Yeah, so these sort of things will be net off against each other, especially for the positive cash in the current asset and overdraft in the current liabilities. So I must say that, for example, for bank, I'll show you my answer later on. We'll get another scenario in, but I must say I'm not so clever in this particular requirement. Yes, you can allocate 2 marks in there. So 3 marks for the first part, 2 marks for the second part. The remaining, yes, 3 marks for the application, because we are required to discuss the issues with the company's treatment of cash flows for the year ended. We need to make our comment whether or not the examiner team, yeah, in this scenario, has treated the case in a correct manner. I will see that later on. So don't be so clever, again in the part 2 especially, don't be put off if you see such requirements in the actual exam. Now, let's read through the background of the case. You see, Fernanda company is the parent company of a group which constructs industrial properties. Right, okay. Now, Fernanda company is currently preparing the consolidated financial statement with the exhibit, okay, for the number 1, the roof collapse, the financial instrument in number 2, and the cash flows issues in number 3. Let's read through the exhibit number 1 firstly, and to deal with the part A. Now we're told Fernanda company is a group constructs industrial properties, and it's September 20X7. Now, the current year end will be 31st December. Again, the event is before the year end, so we are not expected to talk about any sort of IAS number 10 event after the reporting period, because these sort of events happened before the current financial statement year end. And we are told a section of the roof of one of the buildings which it had constructed partially collapsed. All right, so you may think of any impairment of non-current asset, but this is not required in a Part A. However, here, it injured 10 people there. So this means that it pops into my mindset that the company is being sued. Production, which was taking place inside the building, had to be stopped. Right. Now, if you ask about any sort of borrowing costs according to IAS number 23, the interest, if I were to take a loan and to support my production, yes, the interest related to it, I must say that because the production has been stopped and the interest, yes, highly likely that we need to stop capitalizing it according to IAS number 23. However, we're not asked about that. If you're throwing your knowledge, okay, dumping the knowledge into the question, you'll get no marks at all. Moving on, however, no legal action has been brought against the company at the year end. Right. So, because no legal action here, I would say that there will be no present obligation at all. It seems that no one is suing us. Okay. As the accident investigators were still trying to find out the reason for the collapse. All right. Now, the accident investigators will be very, very important here because to determine the probability that we need to pay cash or we need to compensate for the losses of those 10 people. So, because it's at the early stage of the case, they're still investigating it. So this means that I would say that the probability is not probable, okay, that we need to compensate for those 10 people. So if that's the case, then I would say that no is like no provision liability. Now, the investigators were assessing the responsibilities of various parties involved. So this means that it may not be our fault, but we're not particularly sure. With the report expected in February 20X8. All right. Now, because this event, yes, took place before the current year end, and we will get the report 2 months later. It seems to me that in 2 months later, which means next year, so we may be adjusting it as the adjusting event. However, at the current financial statement year end, I would say that no, it's like not a probable cash outflow. The extent of the damage and details of any compensation payments to be made is not yet been determined. Right, so this means that the expenses cannot be reliably estimated. All right. Now, we're not sure whether or not it's our fault, but I would say that it's highly likely that it's our fault. Okay, so I would say although there will be no legal obligation right now because no one is suing us, but I would say that according to the prudent reason, I would disclose as a contingent liability there. Now, finally, the company failed that given the current stage of the investigation into the accident, there's no requirements to record any sort of liability in a consolidated account. I would say that yes, I will support your claim in this time, especially as the company failed that any compensation payable will be covered by the insurance. I would say that because we're not particularly sure about any sort of expenses that we need to pay for, because firstly, it's at the early stage. Secondly, we're not sure how much reimbursements that we can claim from the insurance company. So this means that expenses cannot be reliably estimated. So, of course, yes, no need to provide for provision liability. Because, for example, according to the IAS number 37, I would say that, yes, this is the provision accounting. They can write them in for provisions, contingent liabilities, and contingent asset. We need to fulfill the POR criteria to recognize the provision liability. Firstly, is the probable cash outflow, which means more than 50% of chance we to make the compensation. Secondly, is the present obligation, either arising from the laws and regulation, or you have set that before, which means constructive obligation. Finally, there should be reliably estimating the amount that we need to pay for. Now, all these criteria are met. We need to debit the expense and to credit the provision liability. Alternatively, regarding the contingent liability, on the other hand, if it is only possible cash outflow, which means not more than 50% chance here, I would say that yes, it's like possible cash outflow in this case. You will also say that, well, it seems that you have no obligation at all. You haven't set that because it's not a constructive obligation. It's not arising from a legal side because nobody is suing you. But I would deem that, yes, you will be sued, okay, because it's highly likely that you have injured these 10 people. So bearing certain amounts of responsibility according to the practical experience, it's highly likely that this will be met. And, well, whether or not we can reliably estimate the numbers or the amounts that we need to pay for, but the answer is no. Firstly, it's at the early stage. Secondly, the amount reimbursed by the insurance company, we're not particularly sure. By the insurance company is questionable. And therefore, yes, we meet with the contingent liability criteria here, and we disclose the contingent liability with the detailed disclosure about the nature of the event, possible outflows, and we are not really estimating the amounts that we need to pay for reliably. Now, let me show you my answers. This requirement only gives you 7 marks. If I were you, I would like to certainly write sentences in this paper, okay, to get these marks. Now, because it's more than 5 marks, the step number 1 will always be the quote from the IFRS. But you don't really have to tell the examiner about the IAS number 37. You don't really have to quote the numbers. You can still get the full marks. You don't really have to quote the exact, correct accounting standards name. But if I were you, I'd like to simply say, per the IFRS, provision accounting. Now, a provision liability is recognized if POR criteria, okay, are met. Now, moving on to the second step there, you may say, well, Steve, it's like quoting the IFRS. You simply quote the IFRS related to provisions. Can I quote the IFRS requirements related to contingent liability? Yes, certainly you can. But can I quote the IFRS related to impairment of asset? Because I think that because the roof has been collapsed, and therefore, yes, the asset is being impaired. Why not stop production, stop capitalizing the interest expense if the company takes out a loan for that? No need to do that. There's no marks for those irrelevant points because they are not asked by the examining team. For the application then, firstly, I would say in this year, the damages have not been determined, which means that it's not probable cash outflows, no present obligations, okay, because no one's suing you, and also investigating various parties' responsibilities by the investigators. And the expenses cannot be reliably measured, estimated, because it's at the early stage. At the same time, we're not sure how much insurance that we can claim from the company. So this means that moving on to the final step there, my conclusion, yes, according to practical experience, Yes, disclose the contingent liability, including the nature, the early stage, okay, so meaning that the possibility is only possible and uncertainties over payment to be received, and making the estimates of the payment to be cannot be made reliably. Now, pick up 7 points in there. Of course, you will get the full marks related to Part A. From my perspective, I think that's fair. Now, let's move on to number 2. Number 2, Part 1, is that the company has already disclosed a contingent liability to redeem the put option. Whether or not that's correct there, we need to see that. Exhibit number 2, put options. That relates to Part B, number 1 now. It said in this year, as a result of the business combination, okay, yeah, we combine with each other, buy another company. Our company has written, what do I mean by written? Yes, sold. Now, if a party, for example, party 1, written into the contract and sold the put option to the buyer. Number 2 will be the buyer. Buyer buying the put option means that the buyer will have a choice whether or not to exercise it. If the buyer, which means the party 2, if the party 2 decides to exercise it, party 1 has to exercise it. It creates the obligation to party 1. It seems that's fair. It's like the liability. However, in this case, moving on, the company's written put options to purchase the NCI shareholding in a newly acquired subsidiary called Rundar Company. Right, now, who are we? We are the F company. We bought the R company, but we haven't bought the entire R company shareholdings. So this means that I've obtained control of the R company. However, the amount I haven't bought will be the non-controlling interests, or the NCI for short. This F company, okay, says to the R's shareholders, says to the NCI, if you decide to sell your shares to me at some point in the future, feel free to do so. Right there, okay. It's like the rights to buy out all the R company shareholdings. Okay, I know that it's not from in the SBR syllabus knowledge, but it's the knowledge from the AFM, Advanced Financial Management. But all we're trying to say here is this. We can allow the NCI to sell the shareholdings at some point in the future to the F company. And this is why we're guaranteed through the put option contract there. And to the F company here, yes, the F company, which means our company, will have an obligation to exercise these contracts at some point in the future. So this means that our company would be obliged, okay, notice the word obliged, which means have to, no choice, which means a liability, to purchase the NCI shares in the subsidiary if the put options were exercised by the NCI shareholders. All right then. At the year end, our company disclosed a contingent liability in the consolidated financial statements for the estimated costs of redeeming the put options. Were not that sensible? Well, looking back to the criteria for the contingent liability, possible cash outflows? I'm not sure whether or not it's possible. Obligation, is it a present obligation arising from the law? It seems to be yes, because if they were to exercise it, we'll have to pay for it. Can we estimate the amount of the liability? The The answer is yes, it's written into the contract for the amounts that you can sell, okay? So to exercise the contract using a put option. It seems that, yeah, it needs to be 3 criteria here. Disclosing a contingent liability? I'd rather say no. No, in this case. The reason is because we've written the put options. Now, the put options, because from this contract, it can be turned into cash directly. So it's more like the financial liability that we need to recognize rather than the contingent liability, because it's like the contingent liability usually exists firstly, for example, someone is being sued, alternatively, that you're in breach of the relevant laws and regulations. Thirdly, commonly seen that it's more like a provision liability, is that the company sells products at the same time providing the warranty service. Now, it's not one of those, so I would rather classify the transaction in the financial liability rather than saying that this is a contingent liability, because it seems like meeting with these 3 criteria. No, the best practice would be to classify them as the financial liability. I'll show you my answer here because it's 4 marks question. So firstly, I will briefly introduce the financial instrument IFRS. If you're not sure about that, please do say per IFRS financial instrument. Of course, if you see the examiner's answer, that's according to the IAS number 32 about the presentation of the financial instrument. But if I were you, you don't really have to you don't really have to quote the numbers in. The financial liability should be recognized if it is an obligation to you that you will need to transfer your cash to buy something. And in this case, you're buying your own shares, which means buying your own equity instrument. So if you've got an obligation, you will have to spend the money out. If another party wishes, you will need to spend the money out to buy the things, buy your own shares. Yes, it will be a financial liability to you. Now, let's apply that to the case, is that it seems that the shares contract, namely the NCI put options, okay, now putting the words in, these are contract, including within there, inside there, we've got obligation to buy shares for cash. Okay, so this is why, yes, it's the financial liability, and make your own conclusion. We should recognize the financial liability and to remove the disclosure of the contingent liability. Now, the conclusion here, I'm using the way number 1 to suggest the correct accounting entry. Now, if I were you, I'd like to stop from there. Yes, getting 3 marks out of 4, I must say that I've done a good job to pass this paper. But if you're super clever indeed, you can also say that how you should measure the financial liability. And of course, according to the IFRS number 9, to measure the financial liability, that should be at the fair value. And more specifically, in this particular case, is that the amounts that you will redeem, you will need to discount them as the present value, because present value still is one of the examples of the fair value. So make sure that you're ready. Redeems or to redemption amount, which means the amounts that you need to pay for, okay, pay for the NCI shareholders, discount them at present value, and that would be the financial liability value. Moving on then, okay, now, number 2, okay, related to part B number 2, it's all about the preference shares. Now, we're given 6 marks in this requirement to record the non-redeemable preference shares as equity rather than a compound financial instrument. Right. Now, firstly, it's non-redeemable, which means we are not paying back your investment at some point in the future. So which means you buy my shares, but never think of that I will pay the money back to you, which means non-redeemable. It's a preference share, okay, so this means that it's not an ordinary share. It's highly unlikely that you can attend our AGM or annual general meeting. So in most circumstances, the preference shares, if they are redeemable, yes, it's like a liability to a company. If it is non-redeemable, it's like the equity. However, at the SBR level here, we need to see the detail requirement according to IAS number 32. So this means that, okay, even though it's non-redeemable, we cannot simply say that this must be an equity instrument at this early stage. We'll need to see that the terms and conditions within the preference shares, that whether or not we will pay a fixed amount of money to the buyer. So the fixed amount of money, that could be the fixed amount of dividend or fixed amount of cash that relates to the share price of our company. So if either of these answers would be yes, of course, and that would be a liability, okay, to the company. I will need to see that. Now let's read through the number 2 here for preference shares. So it says, in order to partly fund the purchase of subsidiary, all right, so it's like the company is performing the LBO, the leverage buyout. Again, yes, this is not in the SBR syllabus, but it's in the AFM syllabus later on. The company issued non-redeemable preference shares and recognized them as the equity instrument, right? So this means that it increases the share capital or possibly the share premium. Now, the preference shareholders receive an annual fixed cash dividend of 5% now. Right, so we are paying the fixed amount, which means we have to pay to those preference shareholders. It's like the obligation to the company. And a participating dividend, 7% of the ordinary share dividend now. So this means that the 7% now is like variable, okay? So we're not particularly sure from time to time how much that we need to pay to our preference shareholders. Right, so it seems like we've got a characteristic of both liability and also the equity instrument. We're issuing ordinary shares, something like that. We've got both. We are not having only one. So it seems to me that according to IAS number 32, for the financial instruments presentation, it's highly likely that this will be the compound instruments that we need to recognize. And the company stated that the instrument had the characteristics of equity capital because it provided for participation of future income of the company. So therefore, the company concluded that in compliance with IAS number 32 would be so misleading because it will conflict with the objective of financial statement set out in the conceptual framework. I would say that, yes, you're absolutely right there. You are quoting the requirements from the IAS number 1, which means the presentation of financial statement about the departure of IFRS. So this means that if you think that following the IFRS would not result in the faithful representation or improving the relevance of the transaction, just depart from it, okay? Just stick to your local GAAP, okay, to prepare for the account. It's absolutely fine there. But you cannot use that as an excuse that because I think the shares is like share. So this means that it's like share and put that into equity. You can't use the IAS number 1 presentation of FS for departure of the IFRS as your excuse. Because according to the IAS number 1 presentation of financial statement, he said that in quite really extreme cases that we can apply this exception rule in our accounting treatment. And the company considers the classification of preference shares to be equity rather than a compound instrument. So if you were to correct that mistake, all you need to do is to move your equity element, splitting that into the financial liability and the reserve. So it's important that you recognise that fact, because currently what business is done, so currently is that the business debiting cash onto credit, highly likely in the share capital, and also credit the share premium account, similar to the ordinary shares. However, if I were to correct that mistake, I will need to reallocate the share capital and premium into firstly the financial liability, usually in the non-current liability section, and the reserve, okay, it's like the capital reserve in our statement of financial position. So after correcting it, of course the debit side is okay. So we do not really have to adjust the debit side. We simply debit to remove the share capital and the premium. That's all. Now, let's see my answer, okay, to the part 2 here. 6 marks, yes, I would like to write 6 points, but I've written more than 6 points. You can pick up any 6 points you want. I would say that firstly, quoting from the IFR specifically to this scenario, is that the equity instrument is just to be the residual interest that we use asset, deducting all of its liabilities. It's like shares. We can share the remaining amount in the business. However, the financial liability is an obligation to pay cash. Or yes, you can say that transfer cash or other financial asset, okay, but paying shares and so on to others, I don't really care. But it's just to be an obligation. You have to do it. You have to do it, which means it will be a fixed amount, fixed dollars. Okay, that will be a financial liability. However, a compound instrument includes the element from financial liability and equity. Yes, this is my third point regarding the quote from the relevant IFRs. And also I would say that according to ICE number 1 presentation, that if the departure results in more relevant financial information, yes, you can depart from the IFRS accounting treatment. But from my perspective, it's highly unlikely that students can spot this. So make sure that you focus on the first 3 points from the IFRS quota. Now, let's apply to the case. Firstly, although it is the preference share which is non-redeemable, it contains equity and liability element. I will have to tell the examiner, firstly, is the cash dividend of 5% on the par value will be the liability element, and the participating dividend, about 7% of the ordinary share dividend, to be paid as the preference share dividend, would be like the equity element, because the amount will not be fixed each and every time. And therefore, I will need to measure the financial liability. Yes, you can say that it's like we are paying interests and we discount all of them. But you can also say that because it's the non-redeemable preference shares, it's highly likely that the carrying value of the non-redeemable preference shares due to a fixed dividend will be a financial liability. So what do I mean by that is that the fixed dividend into first year, second year, third year, let's say $10 each, and we need to discount them into today's value. Okay, which means taking 10 divide this into, let's say, 1 plus 6% of the discount rate for power of 1, for power of 2, and for power of 3, and then plots them all together, including, we're not sure about how much money do we need to pay for at the end, because it's not redeemable, and this is why we need to apply more years, okay, of these cash flows. But more specifically, the ways that we can do in practice is to use the perpetuity approach. For example, 10 divide this into 6% there, okay, as the values that we recognize today, okay, as the financial liability. So depending on how much money that you can get, with the residual value, classify that into reserve. So in other words, for the initial measurement, we should debit cash and to credit financial liability, and the balancing figure goes into reserve. Now, my conclusion is that, yes, you will need to further disclose the characteristics of a compound instrument, including the nature of the transaction and the dividend policies and dividend details in there, so to tell the shareholders about them. Now, very, very good questions so far. Now, I'd like to stop the tape now, and I will look forward to seeing you in the next of our recording to go through the most difficult part, which means the ICE number 7 statement of cash flows in much more details, and how to put all of these in the CBE exam software. I will look forward to seeing you then. Bye-bye.
APC, accounting for your future.
Welcome to the past exam question go through of SBR. Now, let's look at the question called Greer Company from the March and June 2023 exam. It's the question 1, and we are told about 30 marks for this question, and we are given 4 requirements there. Now, let's see the requirement part A. So we are required to use the Exhibit 1 information and to evaluate the reasons why the company called G Company, rather than the layout, can be identified as the acquirer in the business combination. So we know that business combination is according to the IFRS number 3. Now, within the IFRS number 3 there, firstly, you know that there would be clear guidance of how to identify the acquirer and the acquiree. And secondly, you will need to think about the acquisition accounting, okay, within the IFRS number 3, including the calculation of goodwill. But in this particular requirement, we are required to identify why the G Company is the acquirer. I'll tell you how in a second. So usually the IFRS number 3, that the acquirer will be a larger entity. So for example, the G Company must be larger than the L Company to a certain extent, and this is why the G Company is the acquirer. Of course, in the part A, when we are answering this question, we can also bring the IFRS number 10, the consolidated financial statement concept, in how to determine control. So in other words, the parent should be the acquirer. And if you can confirm that the acquirer, for example, the G Company is the parent, of course, G Company would be the acquirer here. Now, part B then, using the Exhibit 2 information, and we're going to be required to explain with calculations how the goodwill arising on the acquisition date. So this means that the subsequent measurement, including the impairment of goodwill, and also the foreign exchange rate differences, we are not required to consider into them in this requirement. So we are given 5 marks here. So if I were you, I'll allocate possibly the majority of marks, for example 4, in terms of calculation, and also because in this paper I know that when we are calculating goodwill, 9 out of 10, that would be a step acquisition. And this is why the treatment of the first consideration for the gains and losses, we're going to be putting them into the P&L, and that will earn me another mark. Now let's move on to part C, using the exhibit to explain with calculations So the exam will always tell you that in this paper, the main focus will be the explanation rather than simply the calculations. How the G company will account for the investment in G, okay, in another G company, which means the G company in the consolidated financial statement. Right. We are given 9 marks there. Okay, so we could be seeing the Exhibit 3 in a second, but just to give you a flavour here, is that the Exhibit 3 really talks about from the trade investment in fair value through OCI to the investments in associates of how we account for it. Part dot then using the exhibit number 4 then, okay, it's quite clear by the examining team, calculate and briefly outline in accordance with IFRS 9 financial instrument how the loan would be accounted for during the period from 20x6 to 20x7, okay, these 2 years. Now we are given 6 marks here. I must say that this requirement, if you want to get the full marks, it will be quite difficult indeed. But if you were to get 4 out of 6, and that would be absolutely easy enough, because there would be a very complicated accounting requirement in the IFRS number 9 regarding the modification of that loan. Okay, so we're going to be determining whether or not that would be substantial or not substantial. And of course, in this requirement, that the examining team has specifically said that it is not substantial, okay, in this particular case. And this is why we're going to be bringing the differences into the P&L, and that's it. But if you want to achieve the full marks, and that will be very, very difficult indeed. But if you want to pass this question 1, and that will be absolutely easy for you to do that. So make sure that you always stick to that rule that 1 mark equals to 1 sentence. Now let's see the case background firstly. It's called the Greer company. It's a listed parent, right? And this is the manufacturing group, and preparing for the group financial statement. We are given the following exhibit. Firstly, buying the layout company and goodwill related to layout, and the investment in another company called G, and the loan agreement. Right, so this is why we are required to answer 4 parts here. So now let's see the exhibit 1. So exhibit 1 relates to the part A. The part A going to be evaluate reasons why the G company can be the acquirer. Of course, this requirement is more than 5 marks, and this is why my answer will certainly be, firstly, I will split into the IFRS requirement related to Part A, followed by application to the case, and finally, to give my conclusion of what is going on. Okay, so this is important to split your answer into 3 parts there. Right, now moving on then, Exhibit 1. We are told the Greer company, whose shares are listed, and the layout company is an unlisted company entered into a business combination in 2 stages. I mean, when I was reading the Exhibit 1 information, it was so complicated indeed. And my best approach, okay, the advice I can give to my students is that always draw what is going on, okay, onto the piece of paper. Now, this means that we have got the G company and the layout company, or L company for short. And G company is going to buy the layout in 2 stages. Right, let's move on. On 1st January X7, G company purchased 35% share capital of L and voting rights for cash. Right, okay, just put them down. On 1st January X7, the G company buys 35% shares in L company for cash. And of course, the voting right is 35% there, less than 50%. So this seems to me that we have got significant influence over the L company's operating and financing policy. So this means that it's highly likely that so far the L company is our associate. Okay, just put all the things in before you draw a conclusion of that. And then on 1st April, that the G company acquires the remaining 65% shares. So this means that initially 35% and then 65%, no NCI, because we've got control and obtaining 100% of the L company. And by issuing new shares, right, so we are not spending our cash out, okay, to purchase the remaining 65% shares. So this means that on 1st April X7, the G company buys 65% shares in L using share-for-share exchange. So this means that no NCI at all, because we own 100%, which means the controlling interest being 100% now in L company. So of course, so far, the L company should be the subsidiary of the G company. And we are told, next paragraph, on 1st April, that G company has a market value of $70 million and the L company has a market value of $90 million. Right, so, which means on this date, I would say that the market value of G and L, respectively, that would be 70 and 90. So in other words, total will be 160 million. Okay, so that's all we can do. And if I were to take 70, divide this into 160, that would account for approximately 43.75%. And that becomes 56.25% of the total market value. So it seems to me that in terms of market value, as we can see that the G company is a smaller company. In identifying the acquirer, so usually it will be a larger entity. However, G company is a smaller entity, so let's move on. The G company business represents 44% and layout business 50% of the total value of the combined business. Right, okay, so 44 and 56%. So 44 and 56% of the combined business. Okay, just approximate to those figures. The examiner has done you a favour. After 1st April 20X7, the former shareholders of the G owned 51% and the former shareholders of L owned 49% of the voting rights of a combined entity. So this means that after the acquisition, we can see the new entity here, that 51% of the voting shares owned by the G company and 49% of the voting shares owned by L company. So it seems that, okay, so we dominate more than 50% of the voting shares. So of course the G company has control over that entity, and surely the G company will be the acquirer in this instance. Right, okay, so next paragraph then. On 1st April, the purchase agreement provided a new board of directors of a combined entity, combining or comprising 6 board members of the G company and 2 board members of the L company. So this means that after the acquisition, we can see that the new company's board, so we have got 6 from the G company and another 2 from the L company in a board. So this means that more than 50% of the management comes from the G company, so that would be another clue that we've got control over that company, and surely we will be the acquirer. And the CEO of the layout is the CEO of a combined entity. Okay, so that adds a bit complication in this case, is that the CEO of a new company comes from the L company. So in essence, yes, it certainly have the significant influence over the combined entity, because the CEO would determine the overall strategic direction of the new company. And we're told the board of directors nominates the members of the management team, but CEO has significant influence over the selection of the team. All right. Now, what CEO does is this. The board members, yes, will need to determine who will be the new members coming into the board and will be nominated by all the board members. However, CEO will certainly have a say that who should be coming to the board. But this would not necessarily mean that L company will control the whole board. It seems to me that still the G company controls the whole board, because whoever wants to join the board, okay, of the new entity, that all board members will have a vote, okay, for that. Finally, we're told the management team comprises the CEO and 5 other members, 3 from the G company and 2 from the layout company. Okay, so we have got the, using other color, is that the management team members that 3 and 2, sorry, 5 and 2, plus the CEO, and CEO is from the L company, 2 from the L company, and 5 from the G company. Oh, so in terms of numbers in the management team, still the G company can dominate the management team, and it seems to me that, of course, the G company will be the acquirer in this case. I would say a very complicated scenario indeed, but you need to know what is going on. So if you don't know about the IFRS 3 business combinations for this particular IFRS, the specific requirements related to the acquirer and acquiree accounting, before we determine the acquisition accounting in the IFRS 3, and it's highly unlikely the students can get any marks regarding this treatment or requirement. Now, I would say that per the IFRS, sort of things I can say to the examining team is that, firstly, according to the IFRS, which means the business combinations, of course, I will show you my full answers in a second, that what I would do is that, firstly, I would say that the acquirer would usually be controlling the acquiree company. So what we can do is that we can say usually we will spend cash to buy shares. In this case, it's the original 35%, but subsequently, if we use share for share exchange, we need to determine that who will be the acquirer. So there will be several rules or clues that we can find from the case. So firstly, who dominates the management team, in this case is the G company, and the voting shares, which company has the larger voting shares, in this case is the G company, and usually will be the larger entity. In this case, of course, unluckily, that would be an L company. But this would not say that because in terms of market value, that the L company is larger, so the L company is the acquirer. We never said that. Okay. So not only we can quote the IFRS related to business combinations, but we can also quote the IFRS related to the consolidation, which means the IFRS 10 there. So you can see that, okay, so if you meet with the PAR criteria, which means we've got a power instrument, that we've got more than 50% of voting shares, we can direct its relevant activities related to the strategic parts, and we can get the variable returns from the L company. So if that's the case, then we have control over the L company. So in terms of applications there, so I would say that, okay, I will bring my application in red. Okay. here. Now, firstly, whether or not we've got control, the answer is yes, because we've got more than 51% of voting shares. I can also say that 51% of voting shares will be our power instrument. Okay, so not only we've got 51% of voting shares, but also we can dominate the board and management team. So this means that will be an application to who dominates the management team is the G company. And voting shares with more than 51%, which means the G company. We're not a larger entity because we, in terms of market value, as we can see there, we only account for 44% of the total entity's value. So this means that not meeting with the third criteria. And we're not paying cash to buy shares, yes, for the 35% of the original shares that is paying cash on that. Okay. So I would say that from these clues that, okay, so whether or not we can get variable returns from it, my answer is certainly yes, because it's now my subsidiary. It's our subsidiary. You can get the dividend, okay, from it. So that's how we do it. Now, my conclusion, yes, you will have different conclusions of that. So, for example, the first conclusion would be the G company is the acquirer. They can also say to the examiner, but it will be affected by other factors. For example, in terms of factors determined from the IFRS number 3, business combinations. Alternatively, you can say that per the substance over form principle, that the legal form of the transaction is like, so we are having, for example, dominating the board at more than 50% of voting shares. But when we are determining who should be the acquirer, we need to assess it in combination with other factors determined in the IFRS business combinations, according to the substance over form concept. Okay, so if I were you, I'll just pick up one of those, and that will be absolutely enough there. Now, I've written my own answer, okay, as you can see there. So firstly, I quote from the IFRS 3 and the consolidated financial statements, as we are told just now. And with the application, okay, for each point, yes, in the actual exam, you can use this point format. It will be absolutely fine there, okay? This is not what is so-called the bullet point format, no, because I write it in full sentences. Now, for example, I would say that with Spain cash and 35%, it will be quite a significant part of the total purchase consideration, because out of 100% of your shares, 35% belong to my company, and that's quite huge. And on 1st April onwards, yes, we own more than 51%, more than 50% of voting shares, means that we've got power instrument, and you are my subsidiary. And then the CEO, yes, we talk about, although it's from the L company, but actually dominates the whole board. And in terms of market value, okay, so we are less than the L company, which means the G company is less than the L company. So this means that this criteria is not met, but this will not stop us from classifying the G company to be the acquirer. So making our own conclusion, okay, we need to determine other factors, okay, by focusing on the substance of the transaction rather than its legal form. Now, making sure that 10 marks, 10 sentences, you can easily pass this particular requirement. But making sure that, if I were you, is that for each of the sentence from the exhibit, my advice to my students would be to comment on vote. Okay, so you can simply copy and paste that into your answer. But if I were you, I like to, modify the original sentence from the exhibit a bit further. Okay, so just to make sure that I tell the marker that I'm not copying the information from the case without any comment at all. So if I were you, I like to put my comment firstly at the first sentence, and then I quote from the exhibit information. And that would be a good practice to show that you're not simply copying the information from the case. Right there. Okay, so that's the exhibit number 1. I hope you're happy, which means the requirement A. Now let's move on to requirement B, is to calculate goodwill and to make a comment of that using the exhibit 2 information there. So we are told that on 1st January, yes, we pay 34 million shares for 35% of capital of the layout company. On 1st April, yes, we issued, because we performed the share for share exchange, we issued 25 million shares at $1 each to acquire the remaining 65% of the target company. And our share price would be 2.85 on 1st April, which means at the date of acquisition, okay, of the remaining 65% shares. And we also told that, okay, so the market value of green would be 70 and 90 for the layout. And we treated the 35% shares as the associate, yes, because more than 20%, and that will be associate. And the carrying value on the date that we've obtained control was 36, and we need to update that to fair value, okay. And we also told the identifiable net assets of the L company was 87. So this means that in order to compute the goodwill, we are actually calculating how much we're overpaying to the L company. So we need to subtract that 87 in order to arrive at the goodwill figure. Now, my advice when we are calculating the goodwill is firstly is to lay out the formula and then slot the figures in, and that's it. And from my perspective, you don't really have to get the final goodwill figures right, because the examining team, when we are marking your script and making sure that you include every figure into your calculation. And if you're not sure how to do it, okay, just make a comment of those. Now, part B then. My mnemonic to calculate goodwill would be DCNN. So firstly, we've got considerations, and we need to update them into fair value. In this particular paper, there will certainly be the first investment at the fair value, not the carrying value, and the second investment, because that would be a step acquisition, which means before having control to having control. The NCI in this case will be 0 because we have obtained 100% shares of a target company. So you need to plot the NCI and need to minus the net asset at acquisition date. Now, so this will give me how much that we are overpaying the L company there. Now, let's see then. On 1st January, we paid 34, and the 34 has been updated to the carrying value of 36. All right. So what will be the fair value of that then? So we are actually saying that because the market value, which means quite fair, which means the fair value of equity of that subsidiary, which means the L company, was $90 million, okay, at the times that we buy the L company. And the amounts that we are not buying, okay, is 0 because we now bought 100% of those. So this means that for the 35% of those shares, at the fair value would be, I would take the market value on the acquisition date where we obtained control and times by the original 35%. So this means that what will be the fair value for the original 35% shares there. The L company's market value, we're told 90 million. So that being the case, the first investment fair value of consideration will be 31.5 million there. And after that, we also issued 25 million shares, and the share price, yeah, because we are paying that, we're paying with our shares, the share is actually worth 25 million times by $2.85 each. So we take 25 million that we are issuing times by $2.85 each. That becomes $71.25 million. At the same time, we are also told that the equity value, yes, the fair value of the identifiable net asset, right, so the L company was 87. Now, 87 there. So plus and minus all together, that give me 15.75. Okay, that's it. Now, it's totally acceptable from my perspective that for the first investments, when we are computing the fair value of that, which means the 35%, what you can do is that you can use the fair value of that equity for 87. It's absolutely fine now. Okay, so you can score reasonable marks by doing that stuff. Now, in terms of calculation, yes, you get the full marks regarding this. And if I were you, I know that there will be one easy mark that we can get, which means for the first investment, how about changing from the carrying value to the fair value? Now, because the carrying value of that associate, we are told it was how much? The associate's carrying value was 36. Okay. We update that to the fair value. The fair value we're told about 31.5. So this means that there's been a decrease in value by 4.5 million. So this means that I will say to the examining team that this will be one easy mark. The 4.5 million loss should be taken to the consolidated P&L. So making sure they directly put that into the P&L as a loss. Okay, so that's how we do it. One easy mark, always remember you can get them. Right there, okay, so far that we finished off the Part A and Part B of our requirements. I'm going to be stopping the tape now, and I look forward to seeing you in the next recording about the Part C and especially the Part D. Very tough requirement now. Okay, see you soon. Bye-bye.
APC, accounting for your future.
Welcome to the key facts of how to pass the Strategic Business Reporting exam from 2024 onwards. Now, this exam, again, is 195 minutes in total. This means that 3 hours and 15 minutes of time to tackle this paper. 100 marks in total, but there are only 4 professional marks, so split into the question 2, or perhaps question 4, or question 3. Now, in the question 1, there will be 30 marker question with 10 to 14 marks related to the preparation of the consolidated account, related to consolidated SFP, consolidated statement of profit or loss, consolidated of statement of cash flows. So one of these will be tested. And of course, nowadays, that the examiner in the question 1 will give you the pre-populated spreadsheet. So in other words, the actual working papers similar to what we've seen in real-life accounting. Now we've got the working papers and we've got several notes below that, and what we are required to do is to make certain adjustments and to comment on them properly, and that's all we can do. So for example, related to associates, okay, now the note for associate, you've made the adjustment in your workings, for example, the working 1 there. At the same time, you will need to bring this back, opening a new column on the pre-populated spreadsheet there, and put the numbers in, and that's all you can do. And of course, inside the working, make sure that you demonstrate to the examiner that we've got the calculations inside. So not just in the cell, for example, equals to open a bracket 348 minus 286 and times by 30%. But at the same time, I would like you to show that you put a upper comma here and then 348 minus 286 times by 30% there. So, because showing both would really allows the marker to track your answer more clearly in this paper, in this Excel. So make sure that you get this right. Okay then, now, this paper, of course, question 2 is all about ethics and accounting treatment, whereas the question 3 and 4 were all about the accounting treatment. But make sure that you're aware that, okay, when we are tackling the ethics question, you will need to, from my perspective, the exam approach would be to make sure that you will comment on every sentence given by the examiner. So, for example, perhaps the finance manager is threatened by the CEO to make the accounts look right. So if that's the case then, according to the ACCA Code of Ethics, okay, make a comment of that, and that would be the intimidation threat. Because the accountant may become not objective if he or she is intimidated or threatened by the CEO. And of course, you will need to tell the examiner of what to do. So for example, simply ignore the request from the CEO. And that's all you can do. So simple as that. Making sure they will bring the keywords, for example, the ACCA Code of Ethics, related to, for example, professional behaviour, integrity, competence and due care, confidentiality, objectivity, and different threats to objectivity related to self-interest, self-review, and advocacy, intimidation threat. So make sure that you bring these keywords with associated actions taken by the, for example, accountant in the actual exam. And of course, for the question 3 and question 4 there, the examining team has a style to set the accounting treatment question both from the accountant's point of view and the investor's point of view. Of course, most students, when seeing the question from accountant's point of view, yes, will be absolutely easy enough, okay, so comment on the accounting treatment and something like that. So I would say that the exam approach for this will be to see how many marks for this requirement. If there are more than 5 marks for this type of requirement, make sure the first step will be to quote the general IVAS requirements before you make the application, and finally making your own conclusion of what will be the correct accounting treatment, what will be the impact on financial statements regarding ratios, and whether or not it complies with the conceptual framework and for what requirement there. For any requirements less than 5 marks, so make sure that your focus will be on the step 2 and step 3 rather than just the step 1. And of course, yes, there are lots of IVAS to be tested, 36 IVAS. Of course, in my course, I would divide the IVAS into the assets related standard, income related standard, expenses related standard, and disclosure standard, and also certain current issues. Of course, the current issues from 2024 onwards, the headings for current issues have been removed. And of course, there might be new changes happening in the real life to be brought into our syllabus as well, and we will cover that in due course. So make sure that you're ready for that. And of course, the second style for the question 3 of question 4 there will be from the investor's point of view. Now, let's see the examiner's report's comment from the March and June 2023 exam. Let's highlight the weaknesses from the examining team. Poor time management, lack of depth in answers, okay, the correct accounting treatment, they're not sure about that. What will be the impact of financial statements in terms of ratios and the ethics side and the conceptual framework requirements. So no 3 steps approach has been used in the answer, so this means that lack of depth. So limited focus on investors' needs. Of course, in June 2023, the question 4 part C, the examining team has set a question regarding the IFRS 8 segmental reporting. So what do I mean by segmental reporting? Will simply be we divide the total revenue, asset and profit of an entire business into different industries or based on different geographical areas and something like that. Simple. But we are asked why segmental information is important to investors. Now, a lot of students struggle with this requirement and to misinterpret the question by saying that segmental reporting is according to IFRS number 8, and firstly, we need to identify whether or not it's a business segment. Second, we need to tell the examiner about the criteria of whether or not that would be a reportable segment and something like that, related to the detailed accounting treatment related to disclosures. Of course, this is not the examiner want. And for my students, I would highly recommend my students, when talking about the investor-related questions, you always think about what investors actually want. For example, investor wants this information because it helps them to diversify business insight. It helps them to understand what is going on in terms of total revenue split into different industries and which industry is the most popular industry, and we've got lots of potential inside there, so helping investors to determine whether or not the investment is correct. Helping investors to assess performance, helping them to diversify their risk by putting their money in buying the shares of a target company, and informed decision making, so which means that the segmental reporting information informs investor to make certain right decisions of whether or not to buy or sell the share of a target company, or perhaps the creditors whether or not to lend the money to a company. So this means that providing this segmental information or certain disclosures will help with the investor in these 4 aspects. So make sure in the actual exam in the future that the type of question related to investors will be relatively straightforward indeed. Always bear that in mind, that why it's important to investors, why the information is relevant and faithfully representing the company's specific information is important to investors. Well, it's because it can help them diversify business insights, helping them to assess performance, helping them to diversify risks, and helping them to make right decisions. And this is why we need these information. With a bit of application to the case, you will get these 7 marks and 2 professional marks right in the SBR. And of course, it will easily turn a failed into a pass in the SBR exam. Make sure they're ready. Let's read another examiner's report from the September 2023 again. Of course, a lot of students, poor time allocation in September exam, or perhaps because the pre-populated spreadsheet has been given by the examiner. Students are struggling with that. Lack of application, weak spreadsheet technique in dealing with numbers, right, in the pre-populated spreadsheet. With a bit of practice, that would be no problem whatsoever. Misinterprets the question requirements and inconsistent presentation. For example, I highlighted here. So sometimes students will use dollars, sometimes in thousands, sometimes in millions, and making a marker feeling absolutely confused. So making sure that you will use the same presentation or consistent presentation at all times in your calculations, okay? So I would suggest my students to look at the original question. So if the original question is all in thousand, using all in thousand. If the original question is all in millions, okay, use millions, and that's all you can do. This paper is not the calculation paper at all. Make sure they're ready. This paper is all about the comment part. So make sure that for each mark in the actual exam, make sure each mark, 1 mark equals to 1 sentence. 1 sentence, approximately 1.5 lines, will be absolutely enough there. Right, I'm going to be stopping this section now, and I wish you the best of luck in your upcoming SBR exam. Bye-bye.
APC, accounting for your future.
Welcome. Now let's see a particular case study of how to bring all the ICE number 12 income taxes all together into a written question. And this company is called Host Group, and we are required, with reference to the above information, explain to the investor. Okay, now our job is to explain to shareholders, and that means not in very technical language, but at the same time, for every bits and pieces of the information presented, you have to explain what's going on and why. The nature of accounting for taxation in the financial statement, so which means the taxation includes the current tax payable based on the taxable profit, the under-over provision of the income tax expense related to last year's account, at the same time, the deferred tax implications. Now, your answer should explain the tax reconciliations, and that will be the information presented by the examiner. That's number 1. Discuss the implications of current and future tax rates. Okay then. And that means if there's a change in the corporate income tax rate, which means, for example, enacted before the year end or substantively enacted before the year end, but will be applicable after the year end, when we calculate the deferred tax implications, we'll be using that rate to calculate the deferred tax. And also provide an explanation for accounting for deferred tax in accordance with the IFRS. So, your answer should reflect these 3 parts. So, there are 14 marks here. I will require my students to write 14 sentences with regards to those 3 points. So, from my perspective though, the explanation of the deferred tax, yes, you can allocate possibly 6 marks in here. The current and future tax rates, 1 for the explanation from the IFRS, 1 for reference, perhaps 2 sentences will be fine. And other, perhaps 6 marks or 6 sentences related to tax reconciliations will be fine as well. Now, let's see then. Host Group prepares the account for the year ended 30th November X7. And that will be the year end, right? We'll be seeing the tax rate, whether it's before the year end or after the year end, and what will be that rate. The director's been asked by the investor to explain the accounting for taxation in the account. Okay, so we are acting as the finance director, possibly, and we're going to be explaining that to the investor. The group operates in several tax jurisdictions and is subject to annual tax audits, which can result in amendments to the amount of tax to be paid. So this means the amount of taxes will need to be adjusted according to the result from the audit. We are told that the profit from the continuing operations before taxation, or the PBT, or the accounting PBT, is $300. And based on that, we times by 22% of the corporate income tax rate, and that will be a tax expense in the profit or loss worth of $66 million. But that $66 million would not be the same as the amount that actually paid by the business to a tax authority, because to a tax authority, it says the amount of income taxes paid shown on the statement of cash flows is 95. So this means it creates approximately the difference between 66 and 95. So first of all, may include the deferred tax implications, which we need to be aware of. Now, We are reported the tax charge to be 87, okay, because there will be other adjustments needed. The investor was confused as to why the tax charge was not the tax rate multiplied by the profit from continuing operations, and directors prepared a reconciliation of the notional tax charge on profit as compared with the actual tax charge for the period. Now let's see then. Because we operate overseas, and that's why we've got differences in overseas tax rates, and bringing the difference here will be 10. And also for the non-taxable gains on disposal of the businesses, which means the income exempt from tax, and the tax would be 12, and we don't have to pay for that, and that means we're going to subtract it here. At the same time, we've got tax relating to the impairment of bonds as well. Okay, worth of $9. Yes, we can. We have to pay additional tax on that for the impairment of bonds required by the tax authority. And other tax adjustments, yes, adjusting for other bits and pieces, we need to pay additional $14. So in total, that would be 87 showing in the account. But the amount of income taxes paid is 95. So possibly the actual tax charge of 87 as well as 95. The difference between these two, approximately to be $8 million, will be because of the under provision of the income taxes that we have to pay in the current year's account. So first of all, we need to explain those bases. So your answer, so for host group, first of all, should be split into, first of all, the tax reconciliation. Okay, for a tax reconciliation, what you need to do is to explain the figures line by line, and explaining, for example, 6 sentences. I'm going to write it in bullet points, but you shouldn't do that in the exam. But you can check out the full answer of this question on your own. So first of all then, I'll be looking at, for example, the notional tax charge. The notional tax charge of this question of 66 million, that we take the PBT and times by 22%. But I have to explain to the examiner that includes the deferred tax implications, which is quite different from the amount of taxes that we actually paid to the tax authority. Second, that $10 million related to the differences in overseas tax rate. So why $10 million arise was because that we operate in different parts of the countries. So it operates in different countries. And that's why we've got the adjustment here. And third, related to non-taxable gains. So non-taxable gains is simply be, we've got the income exempt from tax times by the tax rate. The tax rate, we're going to be using 22% here. At the same time, we've got the tax relating to the impairment of bonds and other tax adjustment of 14. So the adjustment in total we got the impairment of bonds, $9 million, and also $14 million worth of $23 million. That stands for the additional tax that the company needs to pay for. The business, or you can substitute that with the company's name, is called host group. Needs to pay for. And then we got a tax charge for the year, and it's different from the 95 in the statement of cash flows. So the difference is between $87 million and $95 million also stand for the under provision of taxes relating to last year's account. And that's why we need to pay additional of $8 million in the statement of cash flows to reflect the fact, and this will be the total taxes that we're going to pay for. So we're also told, let's see then, the tax rate applicable is 22%, but it's a proposal in the local tax legislation that a new tax rate of 25% will apply in the country where it's domiciled, which means where our head office is situated. The tax law and the rate changes are enacted when government approves the legislation, which means in the future we'll be using that 25%. The government approved the legislation, but the current weighted average tax rate for the group is 27%. Host group does not currently disclose the opinion of how tax rates may alter in the future, but government is likely to change, with the result of the new government will almost certainly increase the corporate tax rate, which means the 25% will be used in calculating the future tax, which means the deferred taxes. But currently, the weighted average tax rate was 27%. It's different from the one that we've been using, which is 22%. This could be due to lots of reasons. So one of the reasons could be we acquired lots of subsidiaries. We've acquired lots of subsidiaries, and then the taxes that we're going to pay and divide it into the group's profit before tax. And since the group's profit before tax is less than it should be, because we've acquired lots of, for example, the subsidiaries overseas, they are loss-making, and therefore pushing up the weighted average tax rate a bit higher. And this could be one of the reasons that you can explain. So with regards to tax rate, originally I planned to write 2 points, but now I'm going to write 3 points here. First of all, that 22% will be using that to calculate the current tax payable. And that 22% will be using that to times by the taxable profit, if you like. It's not the accounting profit, but it's the taxable profit we'll be multiplying that by. And then 25% of the new tax rate will be used to calculate deferred taxes. So the reason why this will be a case is because according to IAS number 12, with regards to the tax rate here, we've been using the rate before the year end, or which means we'll be using that rate that has been approved by the government before the year end, or substantively enacted before the year end. And there are multiple clues in the case. This would be a case of 25% has been substantively enacted by the year end, because we're told that according to our experience that the new government will almost certainly increase the corporate tax rate to 25%, and there's a proposal and we've got the experience here, and that's why 25% we will say that is substantively, because it's supported by the evidence. We may also wish to explain the 27% of the weighted average tax rate as well. The weighted average tax rate of 27% is significantly higher than what we've seen of 22, as well as the new tax rate of 25%. So one of the reasons why this could be a case, you can add your thought here in your answer, is perhaps the host group has several loss-making subsidiaries. And therefore pushing up the weighted average tax rate a bit higher. So how many points are written? 4 and 3, and that would be 7. And then finally, I'll be explaining to the examiner for the final of the deferred tax issues. Okay. Now, let's continue then. At 30th November 2007, which means at the event, we've got deductible temporary differences of $4.5 million. And if that's the case, then for deductible temporary differences, we can use that $4.5 million and times by the corporate income tax rate and to recognize the deferred tax asset. But to what extent? Well, the answer is if we have sufficient taxable profit at some point in the future to utilize that deferred tax asset to offset against the future tax the future tax expenses, we can recognize the deferred tax asset to that particular extent. And we're told that deductible temporary differences of $4.5 million expected to reverse in the next year. So if this is the case, then you can reverse that, which means in next year you can reduce that deferred tax asset. But you need to recognize deferred tax asset right now, so you can reduce that in the next year. So the key point in your discussion is whether or not you've got sufficient taxable profit at some point in the future to recognize that $4.5 million times by the corporate income tax rate to the full amount of the deferred tax asset. And also we are told, in addition, that we've got taxable temporary differences of $5 million, which relate to the same taxable company and the tax authority. And we expect $3 million will reverse in 20X8 and the remaining reverse in 20X9. And that means currently we can recognize that $5 million times by the corporate income tax rate as the deferred tax liability. And the deferred tax liability will be reversed in the next year by $3 million times by the corporate income tax rate. And then after that, $2 million times by the corporate income tax rate in 20X9. Now, in discussing about the deferred tax indications, the first step that you need to do is to say to the examiner, this just to be a timing difference, so you can call it as the temporary difference. The timing difference arising from the carrying value of the asset with regards to tax base. And then you can explain what carrying value actually means. It's for those assets as well as liabilities in the financial statement or in the SFP. The tax base for the asset, you can say about it is the amounts deductible against future taxable profit, or the carrying amount minus the future tax consequences. With regards to liability though, on the other hand, the tax base could be the carrying value minus the future tax. And of course, with regards to income received in advance, you use carrying value minus future no tax. Okay, and then you're going to be applying the tax rate of 25%, which is substantively enacted before the year end, and the times by that difference. The times by that difference, it could be the taxable temporary difference, deductible temporary difference. For taxable temporary difference, you can recognize the deferred tax liability. Deductible, you can recognize deferred tax assets. So, applying to the case, first of all, we can recognize the deferred tax asset by taking the deductible temporary differences of 4.5 million and times by the corporate income tax rate, and that will be the deferred tax asset. But you can also say to the examiner, as the next point, as long as we have sufficient future taxable profit, so you can recognize the full of the deferred tax asset to that particular extent. We can also recognize the deferred tax liability, and here will be 5 million because it's the taxable temporary differences and times by the corporate income tax rate. And in 20X8, which means next year, we're going to be reducing that deferred tax liability by $2 million and times by 25%, or the latest corporate income tax rate. And in 2000X9, or the next year after that, we're going to be reducing that deferred tax liability by the remainder of $3 million times by the corporate income tax rate, because it's the reversal of the taxable temporary differences. And of course, what you can do is, when setting up the deferred tax liability, because we've got the deferred tax asset in the first instance, and therefore it's entirely up to you to whether or not you're going to set up the deferred tax liability by taking $5 million times by the corporate income tax rate. Alternatively, you can reduce that deferred tax asset by this particular amount instead of setting up the deferred tax liability. It is entirely up to you. Because according to the presentation requirements, according to ICE number 12, it's entirely up to the entity whether or not to set up the deferred tax asset as well as the liabilities separately, or to net them off. Okay? It is the company's accounting policy to do that. But this is so advanced from my perspective, because how many points I've written? 1, 2, 3, 4, 5, 6, 7, 8. 9, 10, 11, 12, 13, 14, 15, 16. I've made enough points to pass this question, so I'll be stopping from there. And I hope you enjoyed this section of how to tackle the case question like this. Very tough question, but very comprehensive question. If I were you, out of that 14 marks, I would aim to score at least 10 marks in the exam, so I can get reasonable marks to pass this paper. Okay then, and look forward to seeing you in the next of our section, and happy studying. Bye.
APC, accounting for your future.